according to that clock, it's 8:59, but I think it's actually 9:32. So we should be starting. All right. So I declare the Audit and Risk and Finance Committee meeting ARF 23/4 open, and welcome all, and welcome to Alan on Zoom. So our karakia, settle the spirit, clear the mind, prepare the body to achieve what needs to be achieved. Yes. And we have an apology from Councillor Henry. So move in a second or two. Thank you. Councillor Murray Bench and Councillor Joyce. All those in favour? No. Carried. Now we need to also have a change of order because our friends from Bangkok haven't quite landed yet. So in accordance with standing orders, the order of business has changed. The item Aon insurance renewal update be dealt with is the next business item. Move on a second for that. Councillor Thwaites, Councillor Coxhead, thank you. All those in favour? Right, against, carried. Thank you. Yana. Welcome back to the chambers. Look forward to what you have to tell us.
Kia ora all. We'll just get the presentation up. I do wish to apologise for, thank you, Matthew Wilson, who's not available to be with us today. He's been called away to do another presentation. So for those of you who don't know me, I'm Deanna McDonald. I'm the National Client Relationship Manager for Aon's Local Government Risk Practice Group, based out of Hamilton. Okay, so we'll go through a couple of things today. Firstly, we'll touch on the markets and where they're currently sitting. Obviously, you've just had your 1 November renewals, so we'll go through that and how they went, and then some options and emerging risks moving forward. If there's any questions, please don't hesitate to ask, and we'll carry on. Okay. So as you've previously heard from us, we've talked about the global market and that it has been challenging. It's been a hard market for the past approximately 6 years. Now, with that, we say hard because the insurance or insurers are challenging what is coming through. They are wanting to understand your data better. So they require good valuations. They need to know that you understand what your assets are and where they are and how you're looking after them. So we talk about the global markets and the effects of this because we have 6 local insurers that we deal with in the commercial market, and they are all owned offshore. Now, we generally look at your property market, and they are affected by the likes of your natural disasters, so your earthquakes and those types of things, and they set the upper limits on your program. We've been affected a lot recently, more often than not, by secondary natural catastrophes, so your weather events, and these are playing into the insurer's book, because they are happening over and over again, and the attritional losses are what affects your program. And they will eventually kill off a program if they're not looked after. So we need to know that you're putting good mitigations in place for your assets, how you're caring for those and looking after them, how you're modelling for future events, and how you are putting in place the raising of levels, so the likes of your earthquake, that you're fixing your earthquake-prone buildings. What are you doing in that respect? What are you doing with your drainage and your water reticulation assets? How you're improving those? Obviously, I'm not going into the 3 waters today. That's a whole different affair. But in this current market, it's knowing what you're doing with that. the insurers are being more proactive and trying to understand things is the best way to put that at present. So we know we've had Cyclone Gabrielle in New Zealand. We know we've had the 27th of January. And there's been a lot of damage across the country. And they were effectively, there was actually 3 events in close quarters that made an effect. So we had to go over to London in September. We took the team over and we took Stephen Boyle from Botplas to represent yourselves. Sorry. And as well as other representatives from MW LAS, Waikato LAS, or CoLab as they are now, South Island Councils and LAP. And we took them over to London to talk to the markets. Now, Lloyd's is traditional in the fact that they like to see the whites of your eyes. They like to shake your hand and understand you. We have had an ongoing relationship with yourself, and we say we because we include you in our whānau, if you like. You are our client, we work with you as your advocate. So we all go over and talk to the markets and show them what you've been doing. Talk about your assets. Talk about what you are doing as a council. And it's repairing the damage that the media has done, if you like. We know these have been catastrophic events, but how's it affected you? And there's been $100 million of losses around the country on various programs, not your own, but on other programs. So it's just making sure they understand where that affects you. As I say, when we went to the markets, we spoke to the property markets for your infrastructure. We talked to them about the above ground assets, and we also spoke to them on the liability program. So it's making them aware of what's going on in those spaces. So the expectations at the moment was where the reinsurance costs are going to continue to increase. So 1 January is generally when the market will go off and get reinsurance. And we expected those to be challenging, and they were, because of the continuous events that are going on around the place, the weather events especially. But there have been others. There have been earthquakes, there have been droughts and wildfires and so many other things carrying on. So they have been impacting the books. And that cost has then been downloaded onto the programs. We are lucky in the fact that we've got an ongoing relationship with London, as I say, because the likes of America that have had Hurricane Ian, where they have lost a lot of capital in the American market, they're going off to London now as what's called a distressed buyer, trying to find someone to give them some capital to look after their insurance. And they are being price takers. But we have got that ongoing relationship, so it works in our favour. We initially said about a 15 to 20% increase on base rate for the 1 November renewals. I'll go through with that shortly about where we got to with those. I say base rate because that's what they look at before you look at your valuations and how they've increased, okay? So there's continuing inflationary pressures that are going on in the market as well when they look at your claims and how they're going to recover their costs when they pay out. Because you've got the likes of global supply chain issues, you've got the Ukraine and Russia war, which is impacting the marine, being able to get all that product around the world. You have a shortage of a workforce and getting people in to actually do the recovery work. We have clients who are in the South Island at the moment that had a claim 3 years ago, and the asset owners ended up having to go out and be on the tools to do the work because they couldn't get the people out in the trades to do it. So that's trying to recover stock banks and things. It's quite sad that we can't get that workforce in place at the moment. I don't know where they've gone, but after COVID, they've all seemed to retracted and found better jobs working from home and online. But it's that they have put what they call fluvial and pluvial excesses onto the program, which we'll go through shortly, which is your flood excesses. So fluvial being the flood coming down the water, just dropping to the ground, and pluvial being your rivers. I think I've got that round the right way, I always get them mixed up. But the excess water flowing from your rivers expanding. Any questions on that before we go into the outcomes from the renewal? No? Okay. So there's lots of numbers up there at the moment. We have, as I said to you, we were looking about 15 to 20% change on the material damage. That was on rate alone. However, we've been able to do that with your valuations and your rate increases. So that was a good outcome. You had a 12% increase in values alone. So if you take that back, the effective rate change was about 7.9%, which is a very good outcome in this market. The infrastructure, I had originally got, that's an old, excuse the 2021-22, I had thought I'd changed the, it is 22-23, so my apologies. Thank you. I have got the updated one here. It has, these numbers are correct, it's just that I hadn't changed the titles on the top before I sent it through, so my apologies. The infrastructure cover, the premium for that is 327,753. Now that.
They are a year old, though.
Sorry?
Aren't these like, isn't this last year's slide?
It shouldn't be.
This is not the one we've got.
Oh, my apologies.
Yeah.
My
We've
apologies.
got
You've got the new one?
Not 14%, yeah.
Yeah, okay.
Yeah. Do you want to borrow my computer?
Sorry, I'm looking at the one here. I'm not sure why the one there is a bit different. I might not have had the renew.
You want this to talk to it?
I've got it on here.
Oh, you've got it.
I've got it here. That's all right. That's fine. Won't
Park that
ignore
one up.
that.
Yeah.
Okay, so we'll start again.
All good.
The percentage change was 39%. Your declared values had changed by 26%. So that's still quite a good outcome when you consider the rate percent change. I did say the infrastructure cover on there was 323. It's actually had a change and it's gone up to 327. But that's just through final allocations. That was an indicative, but we've been able to finalise that now. The commercial motor has gone down, and that was due to a change in the premium, the change in the fleet values. So that's why that one's gone down. And then everything else is generally about 10% rate increase, which has been quite good. There's a couple of flat ones on the bottom with your standing timber and your aviation hull, so that's your drone policy, and your aviation non-owners, so they're all flat. Business travel's gone up considerably, purely because there's been an increase in travel days. Okay. Now the professional indemnity and public liability excess layer, that has been placed in London, but we're just finalising the premiums on that. So we will come back to you on where that's sitting. But we're, at the moment, best approximation will be about a 15% increase on last year's premium. Okay. Any questions on that? My apologies for that slide not being updated. I thought I'd sent through the latest one, but if you've got it on your books, that's all good.
On professional indemnity, what sort of claims do you get?
building consents generally. That's the biggest one with professional indemnity. So that comes round to advice given by council. And when it comes to district councils, it's generally building consents that they're looking at, but they will increase. This is a better increase than last year's. They tried to recover following a few events that had been going on, and the book had to try and remedy itself. However, we've got a continuation of our lead insurer on that program, and they're happy to keep working with council, because prior to this one being in place, the council program on a whole went through about 3 other insurers which didn't want to lead it anymore. So Berkshire Hathaway have been lead for about 4 years now, and they are still happy to be on board. So they will look at change in income, they will look at the number of consents that are being allocated, they will look at your employees that are on board. Okay. Any other questions? Okay. Oh, sorry. So that's just an overview of what the insurances are and what they cover, just in case any of you weren't aware. Most of them, I think you will be aware of what they all do. If there's any questions, please sing out.
Just through the chair, Deanna, from your perspective, has this council got any areas that we're not insuring compared to, the wider picture?
I'll go through that in a moment, but you've generally got a good coverage of policies. I don't think there would be anything outside of the norm at the moment. We'd need to go through and have a good look at the overall business to understand it. I would suggest, as long as you're looking at, the contract works is a big one at the moment. Because of the change of the Contracts Act, Construction Act, and being aware of where your retentions are, it's looking at who's going to be looking after those retentions, where are you holding them, and having those contracts in place. So if you're doing a greenfield build, then generally that's okay. But if you're looking at a rebuild or an addition to on an existing site, it tends to be, we like to recommend that you hold it as the principal, and making sure that you've got those covers in place. Because if it's attached to a building that you own already, it's how that fits in with your material damage program.
Sorry, just through the chair, one more question. One of the discussions that we've had to date is around whether or not we should insure our bridges. Can you give us a perspective on bridges from Aon?
Sure. So as far as the bridges go, that would be putting them onto, if they're outside of your state highways will be covered on a percentage basis through NZTA. And then anything off your state highways, that comes down to, we can put those onto your material damage and cover them for all perils, depending on the build of them. If they're lifeline bridges, then we can put those on the program as well. But that's an individual per council feeling as to what's best for you. And we can go through and talk to you about that. Okay.
Through the chair, we had a quick chat just beforehand, and I was curious as to what trend you're seeing in the local government sector with self-insurance, and where that might be being applied in terms of what assets, and sort of that kind of broad overview of what you're seeing in terms of responses from the sector. And I might add to that, what does NZTA do in relation to its insurance program?
Okay.
It'd be nice to see how it all fits together.
Sure. So as far as NZTA, they have their own program in place, and that is a contract that you've got with them internally. So I cannot speak on that one as such. As far as the self-insurance, generally it's the larger councils that are putting some self-insurance in place throughout their program, and it's raising deductible levels so that they are self-insuring at a higher level at the bottom. But you need to make sure that you have got the funds available from day one when you put that policy in place, because it's that attritional loss, as I mentioned earlier with these weather events. How many losses can you withstand at that higher deductible rate? If you are going to be having multiple events throughout a year and you've got a higher deductible, can you have that pot of funds sitting there that can cope with that? How soon can you rebuild it? So does that answer your question, Stuart?
Yeah, and are you sort of seeing anything in relation to the capacity of those councils? So, regional councils are generally net investors, but I've got some capacity to have that access to the readies, as you say. But what about the more geared net borrowing councils? I mean, in the sense, is there any sort of observation that you have taken in terms of which councils might put aside or put in place some kind of capacity in the form of standby facilities, etc.? They are expensive.
Generally, as I mentioned, they are the city councils that are doing that. The district councils tend to not have that readiness of too much funds available to them to be able to start accumulating a pot of money, if you like, especially with the increase in costs around the country and whatever it may be. Raising rates to be able to put money aside is not generally a good thing, a good look. So it's being able to just afford it. If you've got a good balance sheet to withstand those sorts of things, fantastic. But it tends to be the city councils that are doing that.
So it's fair to say the provincial and rural councils probably aren't embracing self-insurance.
No, no.
Thank you.
You're welcome.
Thank you. One more from Councillor Coxett.
Thank you. Just a general question, really, probably two-part. So in terms of general insurance, house insurance particularly, are there many regions, suburbs in New Zealand that are becoming or have become uninsurable? And sort of a part B to that is there's been some slope and some slope identification in the Tauranga City Council district. And so it has the potential for slips, not necessarily there have been slips. Where is the insurance industry on that?
Okay. So as far as non-insurable regions in New Zealand, we haven't got that space as yet. It's been an increase. You can buy insurance if you've got the money for it, essentially. Second part, as far as the slope degradation, it will mean that there's mitigations being put in place. So if you're buying land, what are you going to be doing about protecting it? What's the council doing to help with that? So it's twofold, that the council's working with the landowner and vice versa. So if they're consenting it, resource consent, it's that they're making sure it's being looked after.
So is that question now being asked in the questionnaire when you complete your questionnaire for your house insurance? Is that now being asked? I haven't noticed.
I'm not sure. I don't deal with house insurance. I'm sorry,
Yeah,
but yeah.
I haven't noticed that it is. Yeah.
Okay.
One more, Councillor Daly, and the Mayor.
Yeah, Deanna, can you just explain the different excesses for these different policy types? And in the earlier slide, you talked about fluvial and pluvial excesses. Maybe expand a little bit more on that, which I guess will come into that first answer anyway.
Okay. I can't give you the exact deductibles on each policy at the moment because I don't have them with me. I'm sorry. But we can provide those in due course when we get the renewal report out to you in the coming weeks. But they are per policy and they are per council, so they're not across the board. It's what's going to suit for you, and they have been worked through previously. As far as the pluvial and fluvial excesses, that's been applied as a sublimit within the policy for the, that was under the general liability, and they're looking at material damage as well. Okay.
So in terms of our bridge that washed out, for example, is there a fixed policy in place for that already, or is it, we'd have to look at it case by case?
It'll be case by case. I'm not sure where that one was sitting at the moment, I'm sorry.
Thank you, Mr. Chairman. I seem to recall from last year, or maybe the year before, that you were explaining how cyber liability was quickly becoming uninsurable, and yet here it's one of the lowest increases. So
Yes.
what's happened with that?
It comes down to what the mitigation's been put in place in the council as well. If they can't see that there have been ongoing improvements within the system, then the increases will be further. However, council's been looking after their cyber liability, their cyber coverage, so the training's been going through. There's multi-factor allocation in place. There's 7 main points that they look at. And if council's fulfilling all their regulations around those, then you're able to get that. And if the insurer is happy, the minimum increases are there to see. We've had ranges from generally 5 to 15% on cyber across the board with the council insurance. And if there has been anything where they are dubious about it, we've had to go back to council, check on what they're doing. It generally comes down to them completing the form correctly and getting the right people to complete the form. If it's just by one person and not checking with the people that are in charge of that, then that's where there's questions and we need to go back again. But because there's ongoing training, the systems are updated regularly, endpoint detection, all those things are in place. It's helped mitigate that rise.
Thank you.
You're welcome.
All right. That seems to be the questions for the moment.
Okay,
Back to you.
thank you. It's just an extension. Okay. So, opportunities. Fleet type, it's looking at making sure you've got the right vehicle for the right use across the board within council. Generally, claims are made by the wrong vehicles being used at the wrong time, taking them a small town car and utilising it off-road, not utilising the mirrors when you're driving and backing into bollards and that type of thing. So it's driver awareness and making sure you've got the right vehicle in place. So you can look at those sorts of things. Excuse me. Asset valuations, making sure you're up to date on those. OAG, if I remember correctly, last year had mentioned that instead of going through the 3-year valuation cycle, because of the continuous increases in product especially, but inflation as well, that trying to increase those to 2 yearly is probably preferable at the moment, just to make sure that they're on point. We talked about excesses previously, so I don't need to go into that again, but it's checking and going through your purchases, and as Adele mentioned earlier about, is there anything that council should be purchasing that they're not already doing, or vice versa, is there something that you're purchasing that maybe you don't need to, and that you can self-insure in that respect. So it's looking at your program, instead of just going through a tick box exercise every year and saying, oh, we've had this before, this is what we'll do again, making it a strategic purchase. We go through your program, we sit down with you, we look at everything that we're purchasing on an annual basis, even 6 monthly, happy to do that. And we did an insurable risk profile with council a couple of years ago, so maybe it's time that we might revisit that and look again. So we go through every department, check on those things and look at where they're sitting.
I have a question on that one, if I may. In fleet type, we know that there are some insurers in the UK who are no longer offering policies on electric vehicles. because
On which vehicles?
electric vehicles,
Right.
because of the higher repair costs and the big areas they need to store them when they're in the repair shop, and a shortage of technicians and all sorts of other things. And I presume there's a bigger fleet than the UK than here. So is there any murmurs like that in New Zealand yet?
Not at the moment, no. NZI, who do the council program, have actually put in place around the country their own repair shops, which are making it a lot easier. You can ring them up, they put them through, and it's done very quickly. And they've got mechanics in there that are able to fix anything and everything, essentially. They're across the board on it. So, yeah, there's no movement at this stage to not insure any vehicle types.
Thank you. Councillor Daly?
Deanna, getting back to my earlier question, cash reserves, excess levels, can you explain the trade-off, and probably relates to Stuart's question as well, between level of excess or agreed excess and sum insured, and what sort of savings can be made by manipulating those numbers?
At the moment, raising your excesses is very difficult to make a premium saving, if you like. It will make a increased saving because they will be looking at rate alone. However, it's that it's mitigating the increase on the other end. So if you understand, you may raise it, but it will stop that top level premium increase going up further. Is that they're just trying to recover their costs every year. Yeah.
Councillor Crawford?
Does that answer that? Sorry. Yeah.
Going on that fleet type, I was reading the other day, the percentage of police cars are being damaged. It was like 50% or something of their fleet. I know this is about opportunities, but I was interested in your comment about how insurance respond to that.
I'm not sure as far as who does their insurance, but obviously they'll be looking at it's a risk. They're in a high risk. Yeah, they're going out there and doing high speed races, chasing and all sorts of things. So it's they will be paying the premium on those because they are at a high risk career. Yeah.
Yes, going back to our fleet, so how much is claims are being made, or how at risk are we with our fleet, you know, with types of activity they're going to do?
I'm not sure what your claims rate is at the moment, your claims ratio, but I can find that out for you. Okay.
Right.
Yeah. Okay, so as we talked about the insurable risk profiling, it's just going through and checking what you've got on your program and what, making sure we're doing a fit for purpose program with you. So we can talk further with governance about that. Emerging risks, it's really, we've got environmental, whether you believe in climate change or not, I'm not going into that discussion, but there are a lot of weather events going on at the moment. We are seeing retracting coastlines. However, you may, unless you're in Horowhenua, where they've got a coastline that's actually expanding, just depending on where you are in the country, it's looking at those water tables, wherever you've got communities that may be at risk of continuous flooding, landslides, that type of thing, making sure that you're looking after them. Putting those risk mitigations in place, looking after your reputation and brand. If you've got an issue, get in contact, we can help you and look to putting those programs in place for whatever it may be. Inflation, there's not much we can do about it, but at the moment it's 32% on year high, sorry, a 32-year high. So, you know, where are we? What are we going to be doing about this? What are you looking at within business to help combat that? Have you got your business continuity plans in place? Are they being run and tested? And what are your workforce requirements? how many job spaces have you got going at the moment? Because I know in our business, we've got quite a few, and it's difficult to get the right people in the right job and to get that staff retention. So are there any more questions on that?
Yes, through the chair. In terms of emerging risks, and I guess you looking forward as this council and other councils do when they're considering long-term plans and other areas of planning, how involved do you get, or in terms of spatial planning and I mean, there are varying degrees of spatial planning that's being finalised at the moment in New Zealand, and I mean, how involved in terms of the spatial plan are you in terms of looking forward to what those risks might present to that group of councils?
And through the chair, unless we have been formally involved, we generally don't. We can do risk modelling and be involved in that space, but it comes down to the council asking us to work with them on that. That's another part of our business. So we have our broking part of the business, and then we have our risk engineers that are able to do that modelling for you if you require it.
Thanks.
Councillor Daly.
Deanna, just before you wrap up, we're part of BotPlace,
Yes.
as you're aware. Can you quantify what sort of savings we make through your business being a member of BotPlace?
So the collective purchasing helps to spread the risk, if you like, because as much as we market you as individual council, we do actually market you as a whole. So it's looking at what's going on within the BotPlace councils, how they are all providing their data, and it does come back to data, where your figures are, do you know where your assets are, understanding all that. So if you can do that as a whole, the cost savings are quite significant, and we do this across the country with the various council groups. So as I say, we took Waikato, BOP, MW, Hawke's Bay, Northland, South Island councils. We took them all over to London to market, and we did it as a New Zealand Inc. But we marketed you then Stephen presented on the BotPlace councils and drilled down to your individual council and showed them what's going on here. So the savings itself is quite significant than trying to go out and buy it on an individual basis. If you tried to do that, they would be looking at the accumulation of risk. So if you are just buying for this area and the insurers are coming in and saying, oh, well, if there's going to be an event and it's going to be impacting this area, it's going to be quite significant. But because we've got this pot of money coming in from the BotPlace region, it's that spread of risk in this area.
I mean, East Coast obviously was pretty badly hit, but I mean, being bundled with them with that, you say it's an overall sort of determination, but could potentially being linked to a more susceptible area cause problems?
It could be, well, that could have been here instead of Gisborne. So you're balancing that out. You've had events, you're unique. You've had events here, and that's been balanced out with the other councils. So it comes across. Yeah, I can't give you the exact percentage at the moment. I will come back to you on that. Okay, so when we do our final reporting, all that will be included in that. As I say, it's been a week since we did the renewal. We had it all put in place, so we're just still finalising and getting all the info, putting it all together.
A cheeky question. In the sense of looking at that, do you sometimes see across BotPlace the net for the year, the net, the net receivers, the net providers, in terms of coming to the mean. And where would we sit in that? Are we a net giver or a taker?
I think across the whole program, not just in obviously the big ticket items, it balances out when you've got other things, the likes of so aside from your material damage and your infrastructure program, you've got your commercial motor, you've got other programs that you still make claims on as well.
Yes.
So it balances out. I'm going to be a political answer on that one.
Yeah. Is that something that you do? I mean, you would know the answer to?
We can get the answer to that, yes.
Yeah, I mean, it would be interesting to know.
As far as where the claims are sitting across
back of the envelope.
Okay.
But I hear what you're saying.
Yeah.
And understand. Thank you.
You're
Councillor Joyce? Hey. Don. Councillor Joyce.
Oh, it's really a question for Adele through the chair. Raise the idea of a risk profiling workshop. Is that something we're going to pick up on? Or is that something we need to do? And in particular, going back to the whole discussion around self-insurance and what you need to do in terms of having ready funds to make that work. From memory, and it's only from memory, our disaster excess is around 20 million, and we have about 10 million in our disaster fund, which is actually used as part of our internal loan balances. So we're actually already effectively committed it. So if we do review, I would have thought that would be an area that we should look at quite closely, whether our current arrangements of disaster insurance for these big events is suitable and fit for purpose at the moment.
Through the chair, so there's a couple of things in there. So the first one is, yes, I think that's what put it on the table for consideration of council for the long-term plan about what that right level is, given the risk profile that Deanna's talked to. In terms of that risk profile, we have already been in conversation about doing that next piece of work to do a deep dive on our insurance again. What I was trying to work through with the council today was obviously to see your appetite for what we've got, and looking for those gaps, and then we can start to look at where we go to from here. We have obviously had the discussion about whether or not, for example, we look at insurance on bridges. As Deanna talked to today, that risk profile is based on a bridge by bridge basis, and the cost may be so significant that you are probably better at looking at the self-insurance processes as opposed to full insurance. But yes, we are working on all those, and that's part of the long-term plan and affordability discussion as well.
I would point out we do have a few council trees parked on a river upstream from one of our bridges, but we're working on that.
Sorry, one more thing through the chair. In terms of our ability to respond, we do have a $30 million floating arrangement with the bank as well to access when needed.
Councillor Thwaites. Right. All right, I think we're done with the questions. Thank you very much, Deanna, for coming back and sharing this with us, and for the work that you and your team do for us.
Thank you.
Much appreciated.
Not a problem. As I say, we'll be providing the final report to you in the next few weeks, so we'll be able to provide that to Adele and go from there. All right. Thank you.
Now, apologies, people. I was so keen to get to Deanna's presentation that we've got to receive Deanna's presentation. So move in a second to receive that. Councillor Joyce, Councillor Murray-Bench, all those in favour? Right, it's carried. Right, as I say, I was so keen to get to the insurance presentation, I skipped some of the formalities. Just that there are no late items. Any declarations of interest from anybody needs to be declared? No, good. There are no public excluded items, and we have no one for public forum. Right, back on track. Sorry. Thank you. The other door. Been lost. Ross and Thresh, thank you for coming.
Hi.
Thank you, everyone.
Right, thank you. Been a wee while, I think, since I've been here, but Ross was here last time, so we'll carry on the theme there. Thanks for having us again. Right, we'll kick right into a bit of an update, obviously, just to give you some insight. And it's a fast-moving beast at the moment. I think we are at the end of the hiking cycle. I was at a presentation the other week and I asked somebody, oh, when did the RBNZ last hike? And they said, last month. And I said, oh, why do you think that? Oh, because the mortgage rates went up. It was actually May. So it's 6 months since our RBNZ has completed its hiking cycle. And so over that 6 months, it's been an exercise of understanding the delivery and the pain thresholds that are starting to appear. So, and Ross and I look after mainly a lot of businesses as well as councils and big exporters, and we certainly starting to see some weakness and some concerns feeding through. So this little chart up here really sums it up. Some of the things, without being specific about our clients, is what they're worried about, what they're seeing. Obviously, the Chinese economy is quite significant for our exporters. Ross and I have a few exporters, quite a few, and it's a walloping of price, a down, plus volume, right? So the numbers come down for them, their revenues come down quite quickly. One thing that worries me a little bit, and I've just been thinking about it on the flight down this morning, is we're about to hit our peak lamb season, and it's not looking very good because the demand's not there, and there's a whole lot of farmers with their hands on their phones desperate to get their lambs out with no market. So those factors are starting to feed through. So Chinese economy is clearly the big one. Our big customer, geopolitical risks, you know, obviously there's a couple of wars going on. There's flow-through impacts of that into commodity prices and trade flows. Also geopolitical risks that we refer to as there's a lot of economies in these testing times starting to look inward, right? So exporting or importing goods from other countries is probably not a priority when they're trying to look after their own. So we've got that issue. Sales volume leads into the Chinese economy because, you know, everybody's buying less. Top one's exporter. The sales domestically, obviously, discretionary income, I think, is a long distant memory for many people, and it's been quite sharp. So I think people were carrying on, and then suddenly it's just hit a wall, and it literally stopped, and the money's run out. So that's hitting it. Market volatility, which we'll talk about, in particular swap rates. There's been a lot of noise. Currency's actually been relatively stable in the doldrums. You know, Kiwi US tested 57, 58 area. You know, we've broadly been 58, 60 something for quite some time now. But we've seen quite big volatility in interest rates. So sharp moves up, sharp moves down. And it's starting, that consolidation is starting to support that, hey, we've seen the peaks, but it's when are the cuts and when's the relief coming?
And I think that flows into obviously the council's position with its interest rate risk and right, I'll put it closer to me. So how the council manages its interest rate risk, and then obviously we've got a couple of minor breaches that we've been watching for a little while. So we're considering, you know, this overarching economic cycle with where interest rates are and have been, and then obviously how we, you know, manage the council's risk with that. So we'll come to that in a minute.
Yeah. So that was cost of funds there, talking about that. Next on the list, obviously political risk, election, that's still lingering. You know, it was quite topical up to October 14th. Now we're still waiting. We still don't know the outcome. Obviously policies are all going to get knocked around through a three-way coalition. So that's still causing issues for some that want to invest or really, I think, and Three Waters clearly one where we're no better off in knowing what that's going to be. You're very right in mentioning that, Ross. But I do believe a lot of businesses are now looking at political risk because they're just, well, what do we do next? You know, we need something to help us. Receivables, you know, that we started seeing receivables being an issue January, February, when people were pushing out their payment terms, you know, and now you've got people going bust. So wage inflation is settling. We ticked up, our unemployment rate ticked up. So, you know, the labour market is easing, you know, so that's good. Staff shortages, ESG, which, you know, is there as well. So just on a global perspective.
Just before you go
Yes.
to that slide, is the current issues with the Panama Canal affecting our export market?
The current market, sorry?
Issues with the Panama Canal.
Oh, most of our stuff goes up to China.
Yeah.
We haven't heard of any clients of ours complaining about time and getting stuff to market. I think that where they are looking is for a significant drop in trade shipping costs, because we've seen, and New Zealand market's not observable. You don't get a lot of data on it, but you get a lot of data on China to the west coast of US or Rotterdam, all these places. And those prices are back to, in some cases, below pre-COVID levels. So we went up and now we're even lower. And that is a reflection of lower volume, definitely lower volume, and slowing global demand, people not buying stuff. And New Zealand gets sort of ratcheted a bit because they play with our market. We've had a drop in freight costs, but not, I don't think we're fully back to pre-COVID levels. But that Panama thing's not, I haven't heard anything from our client base that it's upsetting them getting goods to market.
Councillor Murray.
Thank you, Mr. Chairman. I would like to go back to the lamb and the market and not being there. Were we selling lamb to China? And is that the only place we sell it to? And basically, our whole survival depends on our ability to trade. And so if our exports aren't going anywhere, that impacts on us against the whole economy, does it not?
Yes, absolutely. Yep, I've got no
And so
question.
where else are we really suffering in that
Yep.
regard?
Now, when we talk about the export sector, and Ross, you know, we look after a lot of different things, and we see that as that's what New Zealand needs to pay its own way, right? That's our productive sector. That's where our money comes from, that we can spend internally on whatever we like. And as I mentioned, volumes, there's pressure on volume and there's pressure on price, right? You know, we've seen the whole dairy story. You know, dairy prices have collapsed and then they've ticked up. Although Fonterra had a very, very good year because it was made up of the past 12 months, so the decline didn't really feed into it. The currency at 58 or 60 cents, whatever you want to call it, is a big relief valve for our exports, and that should be supporting us because, correct, if you're an exporter, you can't make money at 60 cents. You probably shouldn't have been in business. But a lot of those businesses have experienced very high costs, right? Farming, extremely high fertiliser prices, which has now collapsed. Because now farmers are going, well, crikey, if I don't have the revenue to support those high costs, well, you know, we're going to cut what we spend our money on. So, yes, you are absolutely correct, but we are bemoaned to the global market. If they want to buy off us at a certain price, you know, that's what we have to do. But
I think the lamb it'll go somewhere. It'll
it
be
has to
sold
go
somewhere.
somewhere.
It's just a question of how much. And if worst case, they'll flood the domestic market and we'll all have lamb for
Cheap lamb.
Christmas. So
the problem
that might be nice, right?
Yeah, and China is, which we're not talking about in great detail, is they've got their own problems, right? They've got a huge problem. So anybody eating lamb over there is probably going, crikey, I can't afford this now. And so there's rumours of quite large stockpiles of frozen lamb in China, which means, you know, they're not going to add to it. So they might buy less. So it's not falling off a cliff, but the ferocious demand we saw 2020, 21, 22, and every processor we talked to, and Stuart in his old game would know that all they kept saying, record year, record year, record year, you know, and
now it's worse.
Now we look back and we go, well, it wasn't sustainable, right? Yeah. Same with interest rates. It's not, our high interest rates are unsustainable in this environment at the moment, because there's a lot of debt and, you know, things like that. So
just on that, I don't know the exact stats, but I think around half of our land went to China, and then the other half went to other markets. It's quite a
Europe and
bit. Went to
US.
Europe, UK, US, Canada, yeah, Middle East, exactly.
Was really using that as an example. The rest of the export market seems to be suffering as well.
Oh,
But you say
absolutely.
volunteers come back on board.
Well, we sell premium products, and in an economic downturn, the first thing you do is cut out your premium product spending. So we're suffering from the rest of the world's decisions to not buy the best, essentially, which means price just has to be set lower. So our export returns will be lower. But all of that product still gets made, it will get sold, it'll get sent somewhere,
At
it'll
a
be
lower
sold
price.
domestically, just at a lower price.
Thank you. Councillor Cox.
Would it be fair to say that, that relief that we've had from an export perspective has actually only really been US dollar based?
Yeah.
Because the other currencies, we know the TWI is still up there.
Yeah.
And are really reasonably robust.
Mm.
And I mean, it's not a great time to be exporting to Japan.
Yeah.
No.
It's not
Exactly.
and so we're getting kind of a little bit murdered on that, aren't we?
Yeah, we are.
In terms of diversification.
Correct.
Well, the Chinese yuan is weak at the same time the
And-
Kiwi
yeah.
is weak. So everything we
Indeed.
sell to China is,
Although, I have to admit, the euro's not been too bad. Kiwi euro, that's all right. Let's give them, and the pound as well. But we seem to, not a lot goes to the UK as historically. China's our big market, and all the headlines are out there around. It's been talked about quite about us diversifying away from a single market if something goes wrong. So it's probably a good time to revisit that. So just next
Hang on.
one there is
Still got-
obviously global. This
Just a minute.
ties in.
Hang on, we've still got a couple of questions. So we can go back to Councillor Cox here, try again.
Thank you. Can we just get you to elaborate on the ESG that your clients are, these types of things that are being imposed on them, and are they by corporates, government, or other business trading partners? Where's that all coming from?
A lot of it stems from, obviously, it's been driven by banks, right? So banks are now driving the culture that, so every time you say a normal business has to borrow from a bank or 2-3 banks, depending on their size, they are saying, right, what's your objectives? What's your goal? What's your policy? What's your future? What are you doing about this? And then, of course, funding has to be supportive of that. So it's a little bit simplistic. Everybody, I think, can now get a 1% loan to buy an EV, I think, isn't it? You go to the bank, up to 80,000 or whatever it is. I didn't really realise. And the banks are incentivising borrowings. If you set out what you're doing, you're starting here and you can reduce your emissions or whatever, then you get a discount on your funding rate. So it's all been driven through the capital markets as well. So corporates are the ones that went, well, I'm not going to do anything about it, are now having to do it because the banks are engaging with them. So that's driving the behaviour. But yeah, the first step has been, I think, around developing a policy and a structure, working out how you're going to measure these things. I think there's a few accounting firms now that are donkey deep in measuring and auditing emissions.
So the banks are putting it as a covenant to actually have it audited?
No, not a covenant. I wouldn't say that, but it's part of your normal audit now. It's going to be when you have your auditor come and check all your financials are right. It's just your measurements and all that bits and pieces are all correct as well. Yeah, but yeah, there's a drive. Funding is now linked to that, and banks, and it becomes one of those perpetual things where there's a lot of fund managers around the world now that have got believe that they'll only invest in those things, and therefore if you're a fund manager, you've got to be able to say, well, we've invested in these 10 businesses, usually a lot more than that, and all of these meet these criteria. And so it all starts to, and you've got, from what I understand, I'm not an expert on the area, but a lot of younger generation now that have their money in KiwiSaver want it to be in ESG related products, ethical products.
It's always a slippery slope because ethical funds, for example, what's ethical for me may not be ethical for you.
Yeah, there is that debate. Yep.
just one more thing on that. The LGFA is offering sustainable funding. So we got a bit of information on that yesterday. I think it's around a 20 basis point saving. And apparently the LGFA is really good at helping you. The LGFA is really good at helping you to meet those targets or do all this sort of reporting around it. So the cost to councils for that is actually quite low. So it could be worth something to look at.
Right, and we have one last
Carry on.
question, Deputy Mayor.
One more.
I was really just going to make a comment in regard to the lamb situation. China traditionally wasn't a buyer of our sheep meat, but over recent years they have bought quite a bit. I don't think it's quite 50%, more like 40 or maybe even a little less, but around that. It is a lot, and it's been mainly the cheaper mainly been the cheaper cuts, which has helped hold the price up overall much higher than traditionally had been the case, and with them pulling back from the market is why there's been such a drop-off.
Yep, absolutely. So that ties into the next chart, really, if we think about the whole big global landscape is, and this comes from the IMF, so they're not expecting a great outcome at the end of this year and into 2024. So we've got growth falling. So you're in there down the bottom, because, you know, New Zealand and Australia are sort of still quite small in the global landscape. You know, we attracted 2.7% GDP in 2022. We're expected to be finish at 1.1 for this year and then be at 1% next year. Now, they're all forecast, but, you know, they've got a downward slant, right? And so everything we're looking at would suggest it certainly isn't going up. So that's what we expect. There's growth to keep going.
Yep. Councillor Joyce.
Let you talk to
These are their October forecasts, aren't they?
these came out
I think it's end of
September.
September.
Yeah, I just wondering, the risk on China just seems to be underpriced. I mean, going from your previous slide to this slide,
Correct.
they're expecting growth to increase.
Well, that
My
one,
experience of China,
I
which
imagine
deal with-
4% growth in China would feel like a recession, given.
I would do, but
their
I mean,
recent-
just from, I deal with China every day, and they are sick as a dog.
Yeah.
So
Well,
I think, I would say that
again,
that
yeah.
underprices the risks somehow.
I totally agree. And this is, sorry, Ross, just very quickly. One thing I always believe when people look at China is go, don't worry about them. They'll just print money or do whatever and just throw money at everything to, you know, cover over the cracks. But it doesn't appear, although they have committed to doing things and spending on infrastructure and bits and pieces like that, it doesn't seem to be getting any traction. And I think, you know, the biggest issue they have there in their regime is you get angry people, you've got a bigger problem than what money can solve. Yes, and that feeds into that one, correct.
Excuse me. So this just looking at some forward indicators. So taking a whole bunch of sort of indicators and financial conditions to try and predict what is going to happen in the next 4 quarters. And you can see there New Zealand, according to, I think, I can't actually remember where this came from. But yeah, the worst of a bad bunch, really. And you can see, you know, even our trading partners, Australia and the US mainly, China's not on there, but you can see it's a downward slant for pretty much everyone. And this is real GDP growth, so taking out the effect of inflation, what's happening with underlying growth, and it's all pretty soft. And you can see there the projections in the chart on the right for, you know, the main global economies only getting back to sort of, well, the US there only getting back to 0% in 2024. So some of the headline numbers out of the US at the moment are still reasonably good, which is why we have strong US interest rates, but there are a lot of problems sort of bubbling under the surface.
And I think this has been compounded a bit, like when I spoke to you, I can't remember now, but a number of months ago, where our concern was around the domestic side, the households, you know, that's where we were worried, you know, high interest rates were going to do all the damage. But since then, we've seen global trade have issues, our exports, what we're just talking about now. So we're getting walloped on 2 sides now. So, and I think this chart reflects that. You know, we came out of the COVID and we were the hottest economy in the world, rock star, whatever you want to call it, because we had no COVID. Everybody wanted to come and live in here and life was carrying on and everybody was spending money, right? And so you had that aspect, and then we had an export. But it feels a combination of both exports and our domestic, which is a big part of our machine, is starting to look really soggy. And that's why I think we are, you know, there. You know, we went house prices, what, 40%, 50, whatever they were, you know, they're coming off at a rate of knots. And that supported what I suppose our situation up to now.
Councillor Murray.
Why is Japan above the line?
Japan still has low inflation and
Sorry?
Japan still has low inflation and has still has managed to get some reasonable growth. I think with all of the money that they've been printing for the last 30 years, it's sort of finally, well, this right now it's working for them, but they've got to be careful that inflation doesn't run away too much. But everyone else is under the line because growth is headline growth is under what inflation is. So in this high inflation environment, it's quite hard to get real positive growth because that inflation is quite high.
And they still have a 0% interest rate. So that's the key reason. We put in a bit of an oil chart here just to support inflation, the inflation thing. You know, we still keep upward pressure on oil, you know, $90-ish a barrel. I think we're down a little bit from that when these charts were last put together. And one of the key drivers of that is a shortage a general shortage of distilled, you know, petrol and diesel and jet fuel. And there was a bit of an issue, certainly in the last number of months, where people were stockpiling fuel. We can't do it because, you know, we don't even have a refinery anymore. We have to import all our fuel made, and it has to be here on time for us to use. There were a couple of people I know that were scaring me, saying we were 2 shipments away from running out of petrol in New Zealand. If other markets continue to be inward, geopolitical, you know, look after their own, stockpile it. And of course, so that's still a worry. The underlying theme really is you know, you've got OPEC and all those guys going, well, we want $100 a barrel. And then on top of that, you know, we're bringing it in at 60 cents. So it is expensive, right? And there's going to be no relief on the inflation side from oil for quite some time. We can't see the Kiwi going rocketing up or oil collapsing. So that's going to continue to be a bit of a headwind for us.
Yeah, and if you look at the last quarter's inflation stats, there was sort of a couple of key areas that were quite strong, and everything else was pretty benign. So the strong areas were inflation, and council rates was another one of them, up 10% for the quarter. So a couple of areas holding headline inflation up, but if you strip those out, the sort of weaker domestic economy is causing softer inflation in other areas.
And that feeds into our latest inflation update. So I suppose it's the key chart, really. You know, what we've been arguing about high interest rates is we've peaked. We peaked last year and we're heading down, but we're not yet down enough to be comfortable, which is that 1 to 3% range or 2% midpoint. Interesting. I think the ECB or the Eurozone is doing really well at 2.9. Bit of a pat on the back for them. They've got a slowing economy, but we're heading in the right direction. We're at 5.6, the same as Australia, but we've peaked, right? So we're just still waiting for interest rates to deliver. Interesting, we talk about China, they're on the bottom, and about 3 months ago in August, they were negative minus 0.1. So they were bordering on deflation. So these guys, you know, our biggest trading partner, got a lot of issues, right? And they've been along there actually near or under 2% for quite some time.
Yeah. The US is the blue and the red line around sort of mid 3%, 3.7% you can see there. And that's part of the reason US interest rates are still quite strong, is because it came down and then it's sort of ticked higher a bit. It's not come down to 2% or 0%. It's sort of hovering around a little bit uncomfortably high. And so there's this big debate in the US about whether the Fed has to, well, hike again and then keep rates higher for longer. So we've seen the US 10-year Treasury climb from sort of what were the lows, 380 to 5%, which is a 22-year high.
Something like that, yeah.
For US interest rates. So extremely high levels, and really that's kind of hurting. It will go on to hurt the US economy. We've seen that come back a little bit, but those high US interest rates have lifted our domestic long-term interest rates, which is obviously where the council looks to fix its interest rates. So we'll come to that in a minute.
Councillor Daly had a question.
Yeah, sorry, just going back to the oil prices. Are you guys aware of any studies or recommendations to the government to get Marsden Point going again, so we can refine crude instead of
We're
importing
certainly
premium
not
products?
experts on it, but my understanding was it was going to be extremely expensive
To turn around that
to
plant.
turn back on, because you had to keep an old plant going, you know, you can kind of put tape over it and stuff like that, but now that it's shut down, to get it working again it has to be up to modern day standards, which that thing just wouldn't be, so.
Yeah.
You would need to build a whole new thing.
But yeah, we've
which
certainly
isn't
not
gonna
heard of anybody sort of trying to engage with the government to restart that or consider it. Would be nice, but yeah.
They are talking about making it into a hydrogen plant or something like that. So, but I mean, that's the future. You know, New Zealand would never green light an oil refinery in this day and age. It's that ship sailed. So we have to look at whatever government forms. We'll be looking forward to cleaner technology.
Which is where, obviously everything's still about EVs, which we're talking about in insurance and briefly, but yeah, so I don't think you're going to see much on that, but you're going to see a lot on renewables.
The problem is the fleet isn't renewable yet, is it? It's, we're still, 95% fossil fuel driven. So to turn off that oil refinery, I think was a huge mistake, because the country just wasn't ready for it. It was an ambitious goal, but it came way too early. We weren't prepared.
And all that infrastructure in New Plymouth, is that a lot of it being mothballed, and is there no gas is pretty much off the table as well?
I think there's still
gas is still going. Yeah.
I think there's still gas coming out, but I'm just not close enough to Taranaki, I'm afraid. But
So just looking at our headline inflation, you can see that non-tradables one, which is council rates, also your power bill, which was also one of the big things up in the last quarter. That's projected to...
Insurances as well. So those are I think, big numbers that are keeping that up.
The light blue line there, not projected to fall below 3% across the next couple of years. So that's potentially a risk for interest rates staying higher for longer, is that, headline inflation is now relying on tradable inflation to come down, which is the likes of your oil prices and commodity prices and stuff like that.
And therefore to get the equal outcome is of, inflation back to 2%, the destruction has to happen at the discretionary demand side. So it's, think of anything down the road at the shops, that's what's got to be cut. If you've got rates, you've got insurance, you've got utility bills, and I'm aware utility bills will be going up again, something else has to give.
Councillor Joyce?
Actually, it's a very good graph, because you can see the ANZ forecast for non-tradables and the RBNZ forecast for non-tradables, and as also the headline. They don't match. So one of the issues we have is that people are following the RBNZ inflation predictions.
Yes.
And then you look at the interest rate projections, they don't match. So
I'm
aware of the theory that the RBNZ has to predict inflation to come down, otherwise it'll become a self-fulfilling prophecy.
Yeah.
But it does sort of show that the RBNZ figures seem to be more aspirational than real.
Or it's a very good
maybe
question.
a more polite way of saying it.
Or they're not reading, or they're not close enough to where, like the councils or the power companies or insurance companies, and don't have that visibility over those sectors to know what they're doing and how much more they're spending and how interest costs are going to feed into that. Where in that data, when we look at inflation data, we sort of have to, well, what's retail sales doing, credit card spending, it's all that sort of stuff, right? Which is it's not stuff that's updated on a regular basis, if that makes sense.
Weekly, isn't it?
Well, those things are, yes, they are, But the other stuff like you power bills and rates or insurance bills, suddenly, you just get the next bill, right? Whenever it's at the annual period, it's up here. And so they're not, that data's, I don't believe, my opinion, they're just not seeing it and the potential it has. Where, we look after a multitude of clients, including local authorities. So we get an idea of where those thresholds are going to have issues. And when you talk about, say, debt, obviously increasing, there's not many people that have debt growing other than specific sectors. Yeah. This one's a good one.
So part of the reason we printed a strong June quarter.
I'll just make a point on that. It's not just the RBNZ that's been appalling at forecasting inflation. It's not just been the RBNZ that's been appalling. I mean, ANZ's been awful. And most of them have been bad. They've all understated it and not seen the train coming for all those reasons. So, yeah, it's a conservative picture that you're looking at there.
So in the June quarter GDP, one of the strongest components was government expenditure. If you stripped out government expenditure, GDP growth fell from about 0.9% to 0.4%. So quite a big portion, and you can see as a percentage of GDP, government spending has been growing over time. And that, excuse me, the government has been running some pretty large deficits over the last couple of years. And in fact, this year's deficit just keeps getting bigger every time they produce a forecast. They go on to exceed it. So, part of the reason that we have strong inflation has been, and we're in this sort of high interest rate environment, is because government expenditure has kept going. So they've been borrowing to spend, and as an economy, we can't exactly afford it because the other part of the reason that spending has become a bigger proportion is because the tax take is suddenly reducing. So that's compounded the deficit problem, and we're in a situation now where the government has to be borrowing at 5.5%, which puts further upward pressure on those interest rates to fund this deficit. So we're in a little bit of a precarious situation down to thanks to government.
And the change of government, obviously, I think we're all aware of their policies, which is to slash Wellington. But I think it'll be quite a mammoth job. And it's not going to happen overnight. That's the issue. So.
Just conscious of time, so I won't delve too much into the current account, but it's safe to say that...
One more question?
Don't waste too much of your time then, but just in the previous slide, what was the significance of the solid line versus the dotted line in parts? What's that?
The dots is each year's percent, and the line is just connecting them.
So there's big growth in some year or decline in some years versus not much change in others.
Yeah.
Okay, thank you.
Sorry, just one question. Back on that other chart. Sorry, beg pardon. Just one question. We're at roughly 21%. You've got US at 280. You've got Japan and, well, just about every other country, Britain over 100%. It's only Australia that's sitting in there. What does that mean?
Are you talking about debt to GDP?
Government
debt to GDP.
Yeah, in terms of fiscal hay in the hay barn.
Yeah. Well, what it means is
are we structurally actually out of line?
Yeah.
And what's that impact on them if you take that same measurement in terms of funding that deficit? I mean, you've only got to look at the US at the moment with treasuries having hit 5%.
Yes.
Do you guys see that as being something that's going to be a big train on the horizon?
It certainly is a global risk with, and particularly the investors in US treasuries are pulling back. So the likes of Japan and China, two of the biggest investors, they're selling their treasury holdings. So that's, again, pushing that up. But I think governments need to face the reality that they can't just keep borrowing at low interest rates forever and fueling their economy and running these large deficits because the chickens will come home to roost.
Yeah.
And you're right, New Zealand's in a better position than some, but that doesn't mean that we should be running these deficits and ramping up the debt. Yeah, I think we should try and protect that position at all costs, because if a truly big storm did come along, then we would need to rely on that.
We are a small player, and we just export dairy and cows and sheep, and we're not. So I don't think we can go there.
Moving on, sorry.
Just ignore that.
So the current account, that's just kind of indicative of the export situation we've been talking about. So again, highlighting the less than desirable position we find ourselves in.
This one's, I'll do this one, Ross, but this one's interesting and makes sense, right? So this is a survey that Tony Alexander done. I think it's quite good, and he just says people are only spending more money on groceries and a bit of domestic travel, garden tools, hope they might grow some decent vegetables for this summer. But they're cutting everything else, right? So eating out, furniture, online, investment property, footwear, motor vehicles. What we talked about before, when we said tradable, non-tradable. So the only way households can deal with this problem is to cut anything that's discretionary. And so already, there's restaurants going bust. There was one of my favourite breweries closed up shop the other week. And it's surprising, behaviours are changing, and this is a consequence of high interest rates, right? So it's not pretty. And this is where I think we sort of argued all the way through that we did not think interest rates were going to stay up here indefinitely. And, the damage is coming. It's just, we're just still waiting. Now, this just an little slightly out of context, and haven't fed into it with the other slides, and Stuart alluded to it before, but a lot's happened in the last week and a half, and these are the swap rates. So we now got fours back into the swap grid, which is where our interest lies in terms of dealing with the small policy breach and our future interest rate requirements, because we're still going to spend money. We just haven't done it yet, but in the future we're going to have more debt than we currently have, but we want to be able to secure that in interest rates we like. Certainly not in the high fives, mid fives. And so what's happened is in the last week, the Fed came out and said, subtly, we're almost there. They had a rise in their unemployment rate, and suddenly the market went, right, they're at 525, 550, they have a range, they're not going higher, and then probably the next move is down, and therefore the whole swap curve fell over. Now, it fell quite a bit, so that's the gap between the dotted line was 2 weeks ago, and that blue line was yesterday. So, and we talked about volatility and interest rates in our first side. We're seeing big swings. We've seen big swings to the top side, and now we're seeing equal swings to the downside. Now, everybody here in the room has to sort of, you've got Stuart mentioned ANZ. They think that they're going to do another hike. The Reserve Bank should go to 5.75, and then they'll be done. And we're going, well, 5.50 is pretty ugly, and it's happening. People are having troubles. We've got a housing market that's come back away. We've got small business starting to fall, and we're there. So that's what we're saying. So this is a good chart that just shows how much interest rates can move, and that we have to be very careful around what level we want to hedge at. Now, just reflecting back, we've spent, and then we just mentioned it before when Ross mentioned Three Waters again, that that's been plagued every council, because they're going, well, it's going. So debt's going to come down, we're going to reset and kick off and do all those other things. Now, something is going to be different. We're not sure what that is, and whether, what's the debt going to be. So there's still huge amounts of uncertainty around the future, right? And councils still, and local authorities are still the ones that are going to be borrowing the most than the corporate world, because the corporate world's pulling its head in, just going, well, we haven't got the revenue now volume, price down. So those things we've still got to be really mindful when we're managing interest rate risk, because it's just too much uncertainty. So, next one there, Ross. This we won't focus on too much. It's a little bit technical in the way you look at it. But
it again highlights how much interest rates can move in a short
move.
space of time. But you can see the markets, what the market thinks the 90-day floating rate will be in all of those years' time has moved significantly, and that feeds into what swap rates are. So, you know, if you were locking in a month ago, you would pretty much lock in 5%. Now it's sort of 4.50, 4.60, right, for a couple of years, 5 years' time, for example. So, you know, it really does matter where you lock in these interest rates, what interest rates you target. And if we think back to last time I spoke about the RBNZ neutral interest rate, so where we think the neutral cash rate is, the neutral OCR, either i.e. not expanding the economy or contracting. And if that's around 3%, then why would we go and lock in at 5% if we think over the long term interest rates will come back to where that neutral point is?
So we've got a couple of questions on interest rate risk. Councillor Joyce.
Just this, you've raised a very valid point that councils were all planning on their debt disappearing, but the debt wasn't actually disappearing, it was moving to new entities, which would then have to raid the debt. So in the overall market, that's still, the overall market is neutral potentially because, you know, obviously the standards for water quality and wastewater quality going up, increasing. So in terms of the market, there was no great relief coming from Three Waters at all, was there? Because it's just the different entity would be raising the debt and the same people would be paying. Just a different pocket.
At a different
pocket.
A different invoice. Almost.
So,
absolutely.
The thing would have been great for councils, and a lot of councils have been moaning the fact that the debt won't disappear, but it was never going to disappear. It was just going to move.
Correct.
Right. But for you making a decision around hedging, if we're not sure around our forecast, then if the debt's not going to be there, we don't want to lock it in.
And it was how that amalgamation was going to happen, and there was going to be now a new pool or a new entity that was going to service a wider area, and what rates were going to go in there.
There's also another risk that councils, when the debt went off their books, would suddenly go, oh, we've got room to borrow again. And it could actually have increased the total level of debt because the councils would say, oh, I can afford that new library, I can afford that new pool, and because we don't have all this Three Waters debt. So actually the aggregate debt could well have gone up.
Correct. Yep. Absolutely.
Councillor Daly.
Yeah, my question was pretty much the same as Rodney's last bit there, but would you guys see, you know, the debt going to a new entity, that councils would have that mindset that might be considered inflationary because of their propensity to borrow more because you're coming off a lower base?
I think, yes, some would, but you've also got to think about your revenue to debt ratios. If you can't service the debt, because obviously you lose the water revenue. So I think it would be for individual councils to decide, but for some it was more about getting that the relief of having the debt off the balance sheet. Sorry, any more questions on that?
Carry on. Yep.
This is a long-term chart just showing how high interest rates are at the moment in a sort of 15 or 18-year context. So again, coming back to that point about not locking in interest rates that are well above the RBNZ neutral, or you know what we now consider the peak of the cycle. We don't want to, you know, you don't buy high and sell low. You do the opposite, right? So we don't want to lock in interest rates when they're at their peak for a long period of time. We want to have exposure to the floating rate, even though that's a little bit higher than some of those long-term rates. But when rates do start coming down, if you've got good exposure to the floating rate, you're gonna get the benefit immediately.
So in this chart there, what we've seen, and certainly nearly for about 12, 18 months, is swap rates consolidate between 4 and 5%, right? And then in the last few months, we've pushed above 5, right? And we've got a chart to show you that later. But if we go back there, Ross, that one there, and And so, and the red line at the top is above that. So we've got a cash rate of 550. BKBM's the little black one that moves around. That's what we essentially borrow off, floating plus margin. But swaps had consolidated in 4 to 5. We pushed above recently because of this. A lot of it had, I think, has been led by US yields, because the Americans are just borrowing money like there's no tomorrow. I think they were borrowing $1 billion or $1 trillion more than what they thought they were going to borrow, or something silly number like that. And then you haven't got China, because China's got problems. You haven't got Japan, and they normally buy all that bonds because, we buy all their stuff, so it's circular. And they went, right, we're out. We're actually selling them to defend our currency. So those yields got pushed up, and so that was a sort of a market dynamic that created that. We've got them all now starting to come down back under 5, right? That's still between 4 and 5, still a level that's not great. But this little period we're in now reminds me very much of 2007 and 8. If you look back there, the red line was the cash rate. I think it was 8.25. BKBM was going, no, we're going to 10 because people aren't behaving. So the black line was way higher than the red line because it was still pricing in hikes. All the swap rates were under it, right? Because they're going, oh, this is not going to work. This is going to be a problem. Then, boom, the US had their GFC. Banks went bust, or finance companies and all that sort of stuff. Okay. And then, boom, our Reserve Bank was cutting 150 points a time. So we went...
And in between meetings.
In between meetings. So they went from 825 to 250 in a matter of 6 months, or less than that, 4 or 5 months, very, very quickly. So being up here is not an easy ride and comes with its own risks. And I'm just always wary of people think we can stay here forever, because I don't think we can, because of the demand destruction that's going on. Now, sorry, Roger.
$60 million question, if I might ask.
Of course.
And that's a great chart. And
thank you.
It's the 4th time, Stuart.
I'm usually being asked by my wife to tone it down. Sorry, it's just been drummed into me. This is a great chart, and I'd like to ask you, do you agree, do you fundamentally agree with where the Reserve Bank is pitching its neutral? Because if you look at this, that's fair to say since the GFC. But preceding the GFC, going back 25 years, the weighted average swap rate, 5-year swap rate, was 6.5%.
Yeah.
And what's normal? So what's your sort of real, we're intergenerational.
Yes.
So what's your intergenerational thought in relation to what's
You're not
normal?
going to tell us your mortgage rate's 20%, Dave, but that's exactly the context.
Yeah.
I think we're referring to is, and I was thinking about the other day, my dad bought his first house with $6,000, right? So now they're $1 million. So
I think the GFC was a watershed moment, and it really shifted the paradigm in terms of the way economies operate. So you didn't have quantitative easing before the GFC, whereas the answer to the GFC, the answer the central banks took was quantitative easing, i.e. printing money and pumping it in to re-stimulate economies, get them back working. That never went away, and in fact, during the pandemic, we saw that supercharged. We saw that taken to 10 times the amount that they did during the GFC. So the amount of debt that existed pre and post GFC was fundamentally different. So interest rates have to be lower. That neutral rate has to be lower from pre and post because of the amount of debt that was created that never went away. Post the pandemic, pretty much the same thing happened. But what I want to point out is that in 2013, 2014, when we were dubbed the rockstar economy, the RBNZ tried to hike by 1%. They got to 1% and then ran out of steam and ended up in a cutting cycle that you could argue was multi-years and took us from 3.5 down to, we'll say
0.
1% before the pandemic, because then pandemic was kind of different. So my point is that between 2009 and 2019, we had an interest rate that was around about between 175 and 2.5 was kind of the two neutral points. So it was 2.5, went up to 3.5, came down to 175, and then for some reason they cut in 2019. I still don't know why.
Before the pandemic.
Before the pandemic. So my point is that in that 10-year period, the economy never overheated. It never ran away. Things were good, but they were just kind of plodding along, and that was with an interest rate at 2.5 or at 175. So to me, that is the example. That's the evidence of the neutral rate being fundamentally lower than pre-GFC. Well, the question now in the post-pandemic world is, where does that sit now? And I genuinely believe we're going to go back to 2% in the long term. Right? I don't know how long it's going to take to get there, but the amount of debt that was created through that 2020, 2021 period was just astronomical. Like, government balance sheets blew out, central bank balance sheets blew out, household balance sheets blew out. Asset prices followed, they've all come back, but the debt is still there. So that fundamentally has to be paid for, and the economies aren't particularly bigger. They're about 30% bigger than they were pre the pandemic, but all of that debt is nearly double what it was pre-pandemic. So
paid back at those rates.
Yeah, if we take the example of pre-GFC to post-GFC, and the neutral interest rate being lower, then pre-pandemic to post-pandemic, the neutral rate has to be either the same or even lower. So that's why I'm reasonably confident that at 5 or 5.5%, despite, I appreciate your long-term experience, but I think, the environment we operate in now is fundamentally different to pre the GFC.
If we've borrowed beyond our means, and now we've got to bring the interest rates down, and you saw the pain that groceries are incurring for homeowners, how much pain is likely to be endured by the community at large as we go through this next process?
Well, I guess that's what we're going to find out. That's the great experiment of creating all that debt to try and stimulate economies when they didn't need it through the pandemic. Most people survived the pandemic just fine. Didn't need the 100 billion that the RBNZ pumped into the financial markets. We ended up with inflation. We're still dealing with that situation. Now rates have to be higher to control the situation, control the inflation. Where it goes from now, how painful it is, I don't know. I hope it's not too painful, but that situation has to be unwound.
So gazing into the crystal ball for our debt swaps and...
Yes.
Yep.
So look, I just wanted, we did the update and sent it through to Jackson when interest rates were pretty high on 19th of October. You can see there the 5-year swap rate along the top line, for example, was 5.34%, the 10-year at 5.38. And then for where the council looks to sort of manage its interest rates,
which is a bit longer out.
Generally, we delay the start, so we might do so if you go down to where it says 2 years, and then along to say 4 years at 5.15%. Let's focus on that point for a minute. And then if we roll through to yesterday, that's 2-year swap rate starting, the 4-year starting in 2 years' time is now 4.83. So that's a good 30-odd basis points in the space of 2 weeks. And that top, the 5-year swap rate there, 4.97. If I go back, it's down from 5.34. So you can see just how volatile interest rates are starting to get at the top of the cycle, which is what we would expect. It starts to become a bit of a tussle between, essentially buyers and sellers within the market. So the market's debating how high interest rates will be in the long term, whether these economies can sustain these high interest rates. So that's why we start seeing that volatility. But I think for the council, a bit of patience in terms of locking in these interest rates is warranted, because we're going to see, once the market decides that interest rates are too high and have to and will come down, then it'll be a quick move.
And the RBNZ starts to signal that it's done and cuts are next on the horizon. Now, what this doesn't reflect, because the outline swap rates, is the intricate bank bill pricing for cuts. So in the US, they're pricing about 80 points of cuts at the end of next year at the US rate. We've got about 65, and I last looked yesterday, 60. So we've already got, the market is pricing cuts. But with the way the swap curve and dynamics playing with bond markets, it's all, so you've got the long end of the curve is driven by bond yields, not borrower swap rates. And the problem, you've got all these governments going out there borrowing a lot of money still, and the market going, well, you have to front up with a bigger insurance, well, higher premium, because you're not necessarily good for it because you keep borrowing more. So you've got these couple of dynamics playing out. So it's not until the RBNZ says, like, we're done, next moves down, but it didn't want to do it too quickly. Because if it did it quite quickly, then the 2 and 3 year mortgage rates would get very cheap very quickly, and your average householder would just take a deep breath and go, right, dodge the bullet, and be able to get a better rate than the 7s and 8s that I think are being shown at the moment. So there is a bit of a tactic there, I think, being played by the Reserve Bank. They need to drum into households. This is not acceptable. We need to cut spending. But, once we've got this, up creep and unemployment, and, I think Westpac came out yesterday, they're concerned about the housing book, all these little things, starting to feed through, then the tea leaves will be a little bit more transparent. Right, so.
So in terms of Western Bay's debt and cover profile, I've got 2 charts here, one showing the forecast as we know it, and you can see those 2 little breaches there at the end of 25 and 27, 28. And then, if we take away Water's debt, we obviously still don't know what that's going to look like, but using the best information that we have, which is out of date, we could remedy this first breach, but then all of a sudden, our maximum is higher than our existing cover. So, until we have some certainty, and I guess the uncertainty in Waters is kind of playing into our hand a little bit, because it allows us to delay locking in these high interest rates. It gives more time for the market to moderate in terms of interest rates. Avoiding locking in interest rates, at this point in time is probably beneficial. And you can see with the lower debt profile, that breach out at the end of 28 disappears. So we wouldn't even have to address anything out there.
Okay, a couple of questions there.
Oh, look, I'd thank you very, very much for this, because frankly, these 2 charts, the before and after, I personally think are fundamentally the most important charts this council can think about as a back of the envelope look forward, especially going into LTP planning. And I thank you very much for doing this, because this is what I've been trying to visualize in terms of there's such material difference between the 2 scenarios.
Yes.
And almost, as you can see here, and as you quite succinctly put, almost impossible to be able to manage around those small technical breaches, and have no idea what is going to happen in terms of political direction. But it's really, what would be really, really fantastic to have here, Adele, would be under these scenarios where the debt is under each scenario shifting as much as it is. It would be great to get a bit of a back of the envelope as to what our capacity is looking like. For example, the debt to revenue, because that's really what this council's forward, that is basically the hay in the hay barn for you, to be able to understand your capital program under each scenario. Because as if Three Waters was to, for example, take more revenue away, then you can, so it influences your debt, your net debt to revenue ratio, because it is your constraining governor. I mean, it is what's going to influence a lot of those forward thinkings. It's pretty tough for management, really tough for management to be able to have two scenarios, which is what they're doing at the moment, I would imagine, for your LTP planning. But this was really great because it's a great visual on what that actual problem is. So thank you very much.
I'll just add one thing there,
very
Stuart.
helpful.
And now that I just reflect on that, the number of times Ross and I had been in Wellington, we'd met with the DIA, NTU and all this, and it was like, this is happening, this is real. You know, we were a small piece of work, Ross was involved with how the debt cost was going to be transitioned, because we've got a lot of councils' debt profiles, so they were looking at us and it was like, well, this is going to happen. And the number of people that have been working in the DIA and the NTU involved in this, which is now gone out the window really until we know what the new government is going to do. But it was in progress, it was in train as far as we were concerned.
Right, we've got another question from Rodney. John, do you want to comment on this particular?
Yeah, I do. Is that okay? Thank you. So I do agree that obviously debt to revenue ratio is a constraint, but I don't actually agree that it's our biggest constraint. I actually think it's the cost of capital and actually pushing that cost back out to community. I mean, we've got headroom, and we've done the scenario planning in terms of Three Waters in, Three Waters out in spades, so we know exactly what it means for us. We can balance off, we can borrow off balance sheet, we can do infrastructure funding, we can go to CIP, capital is not an issue. It's actually driving cost of finance into our community alongside increases to regional rates or other targeted rate that other councils might do. For instance, for State Highway 29 that could affect our residents. We can't just look at ours in isolation.
You sang my song a little bit. You know, it's not just about what the council can do on its balance sheet, it's also about what the cost of the community, because any borrowing comes back to the community. But the other thing is, I presume these charts are based on our current long-term plan. So, because you guys wouldn't have seen any of the prognostications yet of what the new long-term plan is. It's not ready for the big time yet. You know, the staff and John's committee are still working hard on it. So, you know, bear in mind, this is all based on the 2021 long-term plan. So if we decide to do lots of new and wonderful things, and past history has shown that each long-term plan comes up with new and wonderful things, then this won't be the case. This is only the case based on the current long-term plan. Right.
Okay.
You for a wee while you had no debt, if I'm correct. It wasn't long ago. Yeah. Mm.
Okay.
So the council doubled capital spending each year in the last long-term plan, doubled it. If you don't believe me, read the S&P, which is coming up.
We'll get to the long-term plan in another meeting. So. Back to you, Suresh.
Okay. The maturity profile, you can see where the council is borrowing its tranches from the LGFA. We've been spreading them out, mindful of obviously the cost of, the longer you go, the more you pay. So just trying to balance that. We've got a nice spread and obviously well below our limit. And there's just a bit of economic data and commentary if anyone wants to read it in their own time. But I think we'll leave it there. That's all right.
Thank you very much.
Thank you.
Final questions from anybody? We've had a fairly good thrash as we went through. So all good. Right. Thank you very much.
Great.
So we
Thank you
need
so
to call from mover and a seconder to not that one, that's the Aeon one. Where's Bancorp? To receive the presentation from Bancorp. Thank you, Councillor Joyce, Councillor Murray Bench. All those in favour? Aye. Against? Carried. Right, and it's time for morning tea. So we'll be back at, say, 22. Who are we missing? Right. Call the meeting to order. Live stream is back on, so. We're up to the first of our reports on page 9 of the agenda. And it's over to Azura. Thank you.
Thank you, Mr. Chair. So this report is on the Standard & Poor's updated rating that we've just received. I'm very pleased to obviously say that we've maintained our AA rating. In terms of how we're stacking, I thought it might be useful to just share some of the latest stats that we've received from them. In terms of how we've gone against some of the councils, out of the 25 councils, they've actually said that 2 have been downgraded in this round. And also about 6 of them have got a negative outlook, which really shows that it's a very tough time at the moment, and getting this rating has been quite, demonstrates our balance sheet position's been quite strong. In terms of the key highlights, there's a couple of things that I thought might be useful to highlight in this report. One of the things they did allude to was the fact that the 7% increase that we chose to increase our rating to was quite favourable, and it helped in the inflationary pressures. Another one to note as well was the debt service coverage, which is 172%. And unless anyone has any questions, I'll take the rest of the reports as read and move to questions. Thank you.
Councillor Murray-Bench.
Thank you, Mr. Chairman. Could you just repeat that? The group of councillors that we're involved with when it comes to funding money, they're on the same grading as we are?
No, so all councils are different gradings across the board, so everyone gets their individual assessment done.
So who's the same as us?
I don't have the exact stats because obviously depending on timing, so before Christmas is when Standard & Poor's are completing majority of their 25 councils. However, the stats I mentioned just before was as at end of last week, so where they got to so far. So based on that, they've said out of the 25 that they rate, because obviously some of the councils use Fitch for ratings as well, and 25 of them belong to Standard & Poor's. So based on their rating pool, they've said that that's the sort of stats at the moment, and they're still ongoing up to Christmas is their feedback at this point in time.
Councillor Joyce.
So I thought S&P was fairly standard, so I'm out of date obviously on that. Is Fitch cheaper, and is there any reason to stick with Standard & Poor's, because they tend to be the more expensive?
I can probably answer that.
Because I was surprised that so many go with Fitch.
Fitch is cheaper. Fitch is about 48 to 50,000 a year versus Aussie dollar is generally what Standard & Poor's charge, and I think that's about mid-60s, 65. The Fitch, they're more or less the same in terms of how they are treated by the investment community. So if you get a AA Fitch rating, it's pretty much the same as and treated by the LGFA, because from your perspective, you get a price advantage based on your rating through your funding through the LGFA. The LGFA's credit rating is fundamental to its ability to go out and get cheap money. And it's a collective. of broadly the sector rates from AA minus up to AA plus. And some of the wealthier regional councils are sitting up there, and others in that AA plus. And, you know, for you going forward, and it's the question that gets asked by a lot of councils is, you know, do I go with the cheapest? Do I go with the one that's got the insights into where this local government sector's moving? Because there were a lot of changes by S&P about 2 years ago, which kind of, you know, were they getting it? And then Fitch also then came through with a whole lot of shifts and changes. At the moment, you know, that's the difference in terms of price. And I guess it's not that you would probably change horses in midstream, because continuity and you don't know where Fitch might end up in terms of how they might assess you. There's always a little bit of an unknown with that. But what's really interesting, and I thought that was I thought that you had a very good rating report from Standard & Poor's. But what's really interesting is that, to their mind, the thing that makes you really strong is your ability to tax. And the fact that you made the decision to increase is sending the signal to them that you can make your financial situation affordable by getting more revenue via an increase in your rates. And that would be that was a very appealing component of them saying, yeah, well, you're good for it. And that you're prepared to make the hard decisions in relation to the quality of the revenue that you've got coming through via rates. That's in a nutshell.
Thank you for that, Stuart. All right, so
yeah. So I mean, two things you said that were really interesting, because Fitch used to be the long distant number 3, right? Fitch used to be number 3, a long way behind number 3, between Standard & Poor's and yeah, Moody's. That's what I'm trying to think. Yes. So you know, if they're cheaper and they're actually seen as similar by investors, that might be an opportunity at some point. I would also point out that what you've talked about there with rate increases, S&P is speaking to investors. It's not speaking to the people paying the rates, right? It's interested in how will you be able to repay the investors. So and it's still got value, but that's what their focus is. So from an investor's point of view, it's great that we can raise rates and feel we have room to do so. It's not actually on behalf of our community. Yeah.
all right, so we have a recommendation that the financial analyst report dated 7th November on the Standard & Poor's rating September 2023 be received. Thank you, Mayor James and Councillor Joyce. All those in favour? Right, gets carried. Okay, now on to procurement principles, page 18. And still with a 0. So.
Thank you. So this report is really following on from the workshop that was held previously, and really just to adopt the procurement principles. We just want to make a slight change in the recommendations, and Murray will speak to that, but I just wanted to highlight the change being that we're really bringing this to Audit, Risk and Finance to look at it through the Audit, Risk and Finance Committee lens. The workshop was held during the strategy and policy workshop, so just wanted to note that. And also, we don't necessarily have to fully adopt it on today, because what we will be doing going forward is this will be forming the wider procurement policy, and we'll be using these principles to further develop on that. So just in a nutshell, the policy is being worked on. However, the principles, what we're adopting today, they're not adopting anymore, but what we're actually endorsing today is really based on the New Zealand procurement rules. And New Zealand procurement basically is aligned with what we're proposing here, and that was workshopped and explained. So really, I just wanted to make one further amendment as well, as part of the Rule 3, which is getting the right suppliers and principles. There was an amendment that was discussed during the workshop, and just wanted to amend that to delete the words choosing the suppliers that align with council's values, because it was discussed that regardless of whether they align with our values or not, it's still getting it right, getting the right suppliers on board. So other than that, really it's to go through the 5 principles there, which is number 1 being plan and manage for great results, number 2, fair to all suppliers, number 3 being get right supplier, and number 4, get the best deal for everyone, and number 5, play by the rules.
All right, so we've got a couple of questions, Deputy Mayor, and then the Mayor.
Yeah, I just wondered what is meant by number 5, play by the rules. I think concerns me sometimes council seems to desire to play by the written rules, but there's certain unwritten rules of conduct that I think we should adhere to too. I just wondered what the perception is there.
Sure. So really that's around being accountable, being transparent, and also being, making sure that anything that we're saying we will do is really sticking to all of that. Majority of it is in relation to being lawful and also following our own procurement principles as well. So it's sticking by what we say we'll do and then staying by that. In terms of the wording there, I think it's pretty much adopted from the New Zealand procurement rules, so that's in alignment with that. But if there's any amendments that we further wish to do, we can incorporate that in.
Mayor James?
Thank you, Mr. Chairman. I think Azura may have partially answered it, but I did want to check whether these policies that we're considering here align with the progressive procurement policy of government. And we're not a mandated agency, but I think we're kind of encouraged, or I can't remember the exact wording, but
Absolutely.
we're somewhere on that spectrum. So do they align with those?
Yes, they do. So adopting or endorsing these procurement policies is in line with what the broader outcomes that the government has outlined, and this is pretty much in line with that.
Thank you.
Okay, so as Azura said, I'm going to change the recommendations. So I will move number 1 and number 2 and change number 3, which reads that Audit, Risk and Finance Committee consider the updated procurement principles contained in this report, noting that these will be included in any future review of the procurement policy. So that will go to strategy and policy. So we're not adopting, or as the old wording said. So the new wording is that the Audit, Risk and Finance Committee consider the updated procurement principles contained in this report, noting that these will be included in any future review of the procurement policy. So do I have a second?
Second, Mr. Chairman.
Thank you. Your Worship. All right. Any discussion? Any questions?
Could I just ask one last question?
Sorry?
Could I just ask one last question?
Yes.
Azura, in point 3, get the right supplier, you've added in choose suppliers that align with the council's values. Is that a principle that's within the government's progressive procurement policy as well?
Yes, so the government does have something similar in that, and obviously it's in terms of the government values, they do have that in there. But this is further to the workshop discussion where we looked at it from a different lens.
And just to note, though, that we've recommended that we remove that one because it becomes very difficult to manage what values are, and that's why we're recommending its removal.
Oh, sorry. Can you just confirm what? Because in the agenda, it's point 3 is choose suppliers that align with the council's value. But are you saying we're going to delete that?
Struck out.
Okay. Okay.
Thank you.
No, I wasn't sure if you were putting it in or taking it out, so that's good. Thanks.
Okay, so we have the recommendations 1, 2 and the new 3. We've moved on a second. All those in favour? Against? Carried. Thank you. Sorry? No, let's see. Yep. Over to you, Clint. Health and safety on page 24.
Good morning, everybody. So just a quick overview. I know you've all received the report, but for the summary of performance for the last quarter, incident numbers and the mechanisms of those incidents remain pretty consistent from quarter to quarter. We are beginning to see some of the lead indicator behaviours being recorded within our systems, which means that we can report that back to this group and also our SLT. But a key focus for the quarter was our psychosocial or mental health and wellbeing project, which we're really looking to uncover how working at Western Bay impacts our people and try to improve that where necessary. So a lot of the work in the data gathering process occurred during the quarter, as well as the analysis from our external provider. So we've only recently received those results. And then the final point is the risk review process. We've really undertaken that to understand our critical risk a bit deeper, and then we can more effectively manage those critical risks for our people out there. But if anyone has any questions on any of the content, it's a very quick overview this quarter.
Yeah, thank you. Questions for Clint? I had one. Well,
Just also wanted to note that we have started the process at the beginning of the report around a psychosocial report, and so that engagement with the staff has now been completed, and we've received the initial report, and so we'll be progressing further information as and when we progress our plan around that. Thank you.
just two things. One, because this goes out to the wider public, there's a couple of acronyms in there that I wonder if you'd like to explain. One's obviously lost, TRIFR and LTIFR.
LTIFR is lost time injury frequency rate, so the number of lost time injuries per million hours worked. And the TRIFR is total recordable, so that takes in fatalities, lost time, medical treatment injuries, and restricted work injuries.
Okay, that's good. Thank you. And then the other one that I had a query on was on page 27, with one of the new ones was about vehicle check, a visual assessment of operational condition of the vehicles that our people drive to conduct day-to-day business, which makes sense. But in the graph below, there's recorded of happening twice. So what, they didn't check twice, or they did check twice, or?
So 2 checks were recorded into the Vault check system. So the checks informally are occurring frequently, but this is trying to capture it, trying to get the behaviours for our people to capture it into our Vault check system, which means it can report back on here. It aligns back to the critical risk review. Once we understand, and vehicle operation will be one of our critical risks. It's most of our people are on the road a lot. Once we understand that critical risk, we can put some critical risk controls, and this will form part of it to make sure the vehicles are checked prior to operating every time, as close to every time as we can. And then we can report that back, so that we're trying to do everything we can to try and mitigate that risk, and vehicles being obviously the main component.
So that process flagged 2 incidents, which had to be...
No, just 2 checks were completed.
Oh, right.
That in the system, more informal checks. This is not saying that they weren't occurring. This is purely just saying recorded in the system so that we can get some visible data on it.
Thank you. Thank you. Councillor Crawford.
Just in the near misses, obviously that's quite big in the graph. So it's good that people are reporting that. So how are you mitigating that once you get these new misses, the pathway of how that's addressed? So some of those come from contractors where they're near misses of, but where we can, we investigate those and try and put those mitigations in place. Many of those near misses, we haven't really pushed to report near misses. I would expect to see a lot more than that once we do start reporting that. But they're investigated where on a risk-based approach. So if there's a higher risk to people, communities, or property, they'll be investigated appropriately and controls put in place to try and mitigate that. So they're addressed in the same manner as incidents that do occur.
Just through the chair, I think one of the things that we actually encourage our staff is to report near misses. It's a sign of a good, healthy culture in this regard, because the more that they can do that, the more often that we can get ahead of anything that might be problematic in the future. So we actually want to see a trending up score in number of reportings of near misses as opposed to the other way around, because we think there's a better way to inform us about what's happening. So thank you.
Just probably that. That's good, and I think most places are trying to do that, but often people don't report because there might be some consequence or something to it in a negative way. So how are you managing that to be a positive thing? I know you did mention so that you can get ahead of things, but how is that communicated to those who need to report it?
Through the chair. So, with Clint being on board, we've certainly been increasing our health and safety awareness. At all of our council meetings, we tend to start our meetings with a safe moment or, what's happened so we can raise awareness generally. And we report, about what's happening across the business. I mean, Cedric's area has probably got the most risk in terms of that. But certainly we keep talking about it, we keep informing staff, and we really want this awareness high. So then, and it is a safe place to come forward if there's any issues. So.
And so that's consistent with my site visits. So I ask the same thing, like, are we reporting incidents or reporting things that occur? And some of the feedback is exactly that, oh no, we don't report it because we're either going to get a slap on the hand or it's going to create a heck of more work for us who has reported as opposed to corrective actions. And so a really big part of how I've tried to engage the business is that relationship behavioural type stuff. So we want to encourage people to report it, not because they're going to get a slap, but because we want to make their environment better. And it also then feeds into the psychosocial report. If that's the culture that we've got out in the field, then this report will look to address that, because we want people to be comfortable being at work, reporting where there's something that's not quite right, and then having the company or the organisation able to make those changes to affect our people.
Councillor Murray.
So I just wanted to say the detail of the report is really great, and I appreciate the depth of work that you have to do. Is it getting better, or are you finding that it's starting to increase more?
It's definitely getting better. I think the more I'm finding, the more I'm getting out to the business and engaging with our people, I think the trust in the safety function within the council is improving. And as you gain that trust, then we're going to get better results. So from my perspective, it's improving. Our leaders, I'm not too sure, they may have different opinion, but from what I'm seeing and engaging with our people, certainly we are hearing about more reports. Some of these abusive, aggressive behaviour things, I don't think necessarily in the past they might have been reported, but we're really promoting that we do get a sound picture of that. And so I feel as though our people are more and more comfortable reporting in where there is an issue that needs to be addressed.
I think it's excellent.
So do you want to move the acceptance of the report, Mike? Thank you. Thank you. Second by Councillor. Oh, one more question.
Oh, through the chair. Thank you. I really, really like this report, and what I especially really like is the rolling frequency rates. That just gives a really good idea and visual trend. But thanks very much, because I think that's new.
It may be new to council, but it's not new to industry. It's actually one that a lot of industries are moving away from because it's lag, and a lot of organisations want to get into the lead, which is where we're trying to head as well.
It's really helpful. Thanks.
It shows a really good trend. Yeah.
It does.
All right, so we have a mover and a seconder to receive the report. All those in favour? Against? Carried. Right, Risk and Assurance Report, November 2023, page 31. And just to note, while Azura's coming up, on page 49, under 1.4, it states that the forward policy and the sensitive expenditure policy will be presented, or they're going to be presented here, but they're not. They're going to be presented at the next strategy and policy workshop. So it's a slight change to the wording there. So they will be presented at the next strategy and policy committee workshop at the well, that is November. Yes. Thank you.
Thank you, Murray. So obviously this is a risk and assurance report update for November. The report has three main parts to it. The first is being the strategic risk register. Number two is the emerging risks and how they link to the strategic risks. And then the third part is the internal audit program. So I'll probably cover off in that order. Effectively, across the board, we've re-looked at our strategic risks and done a workshop to see where do they stand. And you've heard from Bancorp as well as our friends from Aon today on the emerging risks. So they're very much, this day and age, it's in the VUCA world, as they say, a lot of volatility and ambiguity going on. So in terms of that, across the themes, we've got about four really key areas that we've highlighted and really delved into as part of this quarter's strategic risk review. The number one being obviously the government changes and the reforms and things. So that's really highlighted for us a lot of uncertainty. Number two being affordability, concerns around rate rising, interest rates, all of the above which we've spoken to today. Also deliverability of our program. So the capital delivery program, as we're looking through the LTP as well, we're really looking at that quite high, turning our minds to what is the deliverability, what does that look like, what is the skill shortages. So those have really been in front of our mind. And thirdly, we've been really looking at the digital connectivity between councils and also what's the new technology risk coming through there. So as a result of the review, we've updated the 9 strategic risks that we previously reported in the last quarter, and now we've reported it to 10. The new one being the technology enablement and resilience, which has been updated in this report. Obviously, as part of this, we've re-rated some of those risks, and I just wanted to highlight that there have been some of them where we've actually increased the appetite for, and those are the 6 which we've listed there, which is operational risk, health and safety and wellbeing, community sentiment, growth and financial sustainability, and also, last but not least, is the government reform. So those have all increased within the report. In terms of the layout of the report, I thought it might be useful just to have a quick summary of that, because it has changed from what you're used to seeing. And so what we've done there is really highlighted after every risk report, after every strategic risk, we've highlighted what are those emerging risks immediately after it, so then it's a little bit easier for readability going forward. And in there we've highlighted what's planned right now, and then what are we going to do, what else are we going to do about it going forward. And so those are also within that. And so in terms of the emerging risks section, just to highlight the key areas, there are a number of areas where we've really looked at the emerging risks, but I think it might be useful for this committee just to consider from each of those risks, what are those new risks that we've identified as emerging risks. So I thought to pause here and take a moment to go through each of those, and then if there's any questions at the end, I'm happy to take it, or even through that process. So I'll start with the operational risks. So beginning with that, in terms of what are the emerging risks that we're seeing in that front, there are 2 that we've added there. And so that is the government reform uncertainty and the evolving legislation. And the second one we've added, in addition to what we already had in the last quarter, was the retention of institutional knowledge, which is really highlighted at the moment with all of the staff changes that are going on, and also a lot of new staff coming in for certain areas within the organisation. Going to the health and safety and wellbeing section, the new emerging risks that we've added in that section is the increasing need for vigilance over the staff wellbeing. So this is really front counter staff. You've got those situations where there are public confronting our staff and confronting situations going on. So we've highlighted that as a new emerging risk for our health and safety and wellbeing. Number 3, in the community sentiment area, we've added central government reform and also the impact of the community perception on the local government. And also, in addition to that, the second item we've added there is the increasing expectations from the community following the extreme weather events, which, as we all know, is costing us quite a lot, and it's quite a topic that we are discussing through our long-term plan process in terms of how we're going to mitigate some of these going forward. Going to the partnership with iwi and hapu, we've added the need to collaborate, define and agree authentic treaty-based relationships in the context of local government as a new emerging risk within that. Climate change, we've added 3 new emerging risks in that section. So the 3 new ones are growing need to understand the impact of our climate change lifeline assets. Number 2 is the balancing costs of the implication, working through climate response and how do we fund these. And again, another discussion that we're having during our long-term planning process. Number 3, the new additional one there, is ability to meet climate-related disclosure and reporting. That's obviously evolving. It's very early days in maturity in that area. We are keeping attuned to what's growing in that area, and there's really a number of things that we're doing internally to try and mitigate some of those risks. Going to the growth and financial sustainability, we've added one new item there, which is the uncertainty around Three Waters. So obviously that's been discussed a number of times, but now we're actually calling that out as an emerging risk given the uncertainty continues. Central government reforms, obviously with central government impacts going on, we've called that out again, including and understanding the uncertainty of the future, especially around the water model. I think that's quite important for us to get our heads around, and we're obviously doing as much as we can in this space in the emerging risks, so we've added that as well. Going to the section on significant external events, so we've got 3 new emerging risks we've identified in that section. Really the first, the 3 ones again spoken about in some of the other areas, but severe weather events, cost of insurance, and community increased weather events. Again, some of these risks are interrelated, however, we've really gone into each one and identified specifics around each one of those as well. And the last 2 there, so people and capability, we've added to, again, some of this is a little bit interrelated risks, however, we've called it out in this section. So retention of key staff and loss of institutional knowledge under that specific risk. And last but not least, the new risk that we've added there is technology enablement and resilience. It's very much of a focus for us, and also going on to the long-term planning, we'll be looking at this further, and that's the end of life of our ERP, so we've really called that out as a new risk. And again, tying into it, another risk that is across the board is loss of institutional knowledge, which is specifically stated on this one. So those are the specific updates to the emerging risks, and also tying into the strategic risks moving from 9 to 10. Last but not least, the 3rd section of the report really covers off the internal audit plan and how we're tracking. So we have had a GST and FBT review completed, and we intend to bring that to the next council meeting. Thank you. Open to any questions within that report.
Hey, James.
Thank you. Given how tightly we try to keep the strategic risks, we've gone from sort of 11 down to 9 and then back up to 10, so but a tight number. Can you perhaps talk through a little bit more why you've chosen to add technology enablement and resilience as a strategic risk? Because on first reading, I was thinking maybe that comes more under an operational banner, if you like. So perhaps you can just explain the thinking there.
Sure, and I think it's quite valid questions. I think in technology, we're seeing a lot of futuristic things going on at the moment. Aside from just our own ERP being, quite outdated, and we're working through that process, but there is a lot of AI influence coming on. There's a lot of agile work that's being done in terms of predictive forecasting, and all of this really comes back to how agile we can be in that space. And the more we looked at it, the more it came to light that actually we need to be flagging this, we need to be looking at it, and we need to be mitigating ourselves in terms of the future risks that are emerging in this space.
Thank you.
I just see you noting the loss of institutional knowledge. So you're indicating it as an emerging risk. That's actually happening, or is it as in we're losing staff, or is it that there's perceived that we might?
It's probably happened in some areas, so it's really just showing that there's a certain time frame where people work, and especially in some of the areas such as finance, we've had a turnaround over the last 2 years. So some areas have lost significant key staff, and so we're flagging that going forward we need to be on top of it, looking at the agility, and also in some of the other areas it is potential to happen because we've actually been sent certain reviews recently where we're reading that actually the life of an employee is actually about 2 to 3 years going forward, And so that means as an organisation, we need to be looking at those future trends and are we ready, are we doing enough things to actually mitigate some of those risks? And maybe the way that we look at staff retention is quite different going forward.
Councillor Murray Bench.
You mentioned the need for agility, and I'm looking at item 3 and ongoing uncertainty around RMA and Three Waters, etc. We're so vulnerable to central government dumping on us all the time, and so I appreciated your word agility. Are we ready for those reforms? Can we cope? Have we got enough agility to be able to manipulate our way around the changes that are going to come?
I think, are we ready? The question will be, we are preparing ourselves as much as we can, and I think a lot of the councils are in the same space as us. There's a lot of uncertainty, so I think that's why, being front of mind and having these things in place is really key, and I think the Chief Executive will probably want to talk to a little bit about that as well. Yeah. Do you want to say something, John?
Yeah, I guess we can only play what's in front of us to a certain extent, but also to, try and work out what's going to happen over the next few months, right? So it's still pretty unclear to us what's going to be happening with Three Waters, whether we are going to have a complete, I don't know what the word is, rescinding of all of the legislation or what it's going to be replaced with. So, although I think we're well placed. I think we've got the attitude of being ready, which is quite often 50 or 60% of it, or maybe 80% of it. And then, we'll just have to deal with it as it comes along. Where it becomes really interesting for us is, we're working through LTP at the moment. Try to understand the implications for LTP. Is Three Waters going to be in? Is it going to be out? It's not as simple as running 2 sets of books to say whether it's going to be in or out or not, because actually, if it's out, you guys will actually make different decisions about your priorities for what funding we have got available, because you won't need to worry about some of the big projects anymore. So it actually changes a lot of our strategic thinking and our way forward, particularly around the LTP. Brings real complexities to it.
Thank you, sir.
I just wanted to add to that, while the reforms and where they sit, there's certainly a lot of uncertainty with that. I think one thing that is apparent to me is that we're going to be far more in charge of our own destiny with the changes the new government might make. So Three Water reform might change, but we might be more in the forefront of making that decision about how that's going to look. So I think the agility that you mentioned, Councillor Murray Benj, is partly down to us. So I'll just leave it there.
John, what's keeping you up at night at the moment?
No, probably LTP, to be honest, and the complexities of what we're finding in that space. We've talked about Three Waters. I think we've got a bumpy journey ahead of us in terms of resolving our priorities within our LTP, given the increases in costs, obviously, and the cost of capital, the headroom that you mentioned this morning. I think that we need to make sure that we take the time to get that absolutely right. That we're having great conversations in this room in terms of what our priorities are, how they're going to impact our ratepayer, and then, as importantly, making sure that we've got time to listen to our ratepayers as well about what I think will need to be some trade-offs.
Councillor Daly.
I was just wondering, is there risks further down the list regarding the governance side of council?
Sorry, didn't quite catch the end of that regarding.
Are there any risk profiles attached to the governance team makeup?
Which governance team?
The elected members. like every time we have an election, obviously there's a potential for some cats amongst the pigeons, so to speak.
I'm not going to identify who's a cat and who's a pigeon, but I think look, it's a little bit. Yes, it does. It creates I guess uncertainty. You know, and that's the same with the general election that you're seeing now. So what you're seeing now and what you're experiencing in terms of thinking about what's going to happen, who the personalities are going to be, how that's going to impact strategy, how it's going to impact policy, that's the same feeling we go through every time, and probably existing elected members when new ones come in. You know, it's just that level of uncertainty. There's always a reasonable amount of downtime, I guess, in any change of governance, whether that's central or local government. So it does, you know, it can impact us in terms of in that way and slow things down. You'll get people that come in that have, you know, we've seen that this year in a very positive way. We've got different people at the table that have different priorities and different things that are important to them. So that, you know, that means that we have to, you know, touch the steering wheel a little bit, you know, brake a little bit, accelerate a little bit in different directions than we might have previously gone. So it's just about, you know, tweaking and aligning. But yeah, it creates some uncertainty.
All right, so mover and seconder to receive the risk and assurance report. Councillor Murray Bench, Deputy Mayor Scrimgeour, all those in favour? Aye. Against, carried. Sarah, you're up. Financial performance report. Page 52, people.
So see, this is our financial performance for the last quarter. In terms of the revenue, we're tracking pretty much 25% to the, 23 and 25% respectively to revenue and expenditure, so in pretty much tracking to par. In terms of our capital expenditure, I think that's where we're a little bit behind at 12%. We obviously see this trend usually in the first quarter of most councils, so that's not it's not anything surprising. And also just wanted to note that actually these are 1/12 of the budget, and that's why it's looking like that. We will be doing a reforecast and rephasing, and so then in the next report that will come to you will be an updated phased budget as opposed to just a 1/12, especially in the capital area. So that's just to be noted. The surplus for the quarter was 4.5 mil, largely driven by 3.7 mil, which was a bit behind in subsidies and grants. Majority of that is from Wakakatahi spending. Obviously, because of the delay in capital, it's also counter affects the delay in receiving those subsidies. At a real high level, our debt position, we did draw down 5 million in the last quarter, and that is now at 95 mil. And obviously the budget is 145 mil, but again, due to the delays in capital expenditure spend, we haven't actually had to draw down that. And it's quite advantageous in this high inflationary times actually to be prudent and just draw it down when we need to. And also just wanted to say that at an overall, our debt, interest rates and liquidity portfolios are tracking well within, and you've heard from Bancorp earlier in terms of our minor breaches. And I'll pass it to Sarah to go through some of the detailed variances. Thank you.
Thanks, Sarah. Yeah, so if we just go to the profit and loss, our rate income is tracking not too bad year to date. If you look at the balance sheet as well, our debtors look really high. There's two reasons for that. We're currently undergoing an internal debt management review to make sure that our debtors are being turned around faster, as well as the timing around the rate revenue as we went out later due to the lateness of the annual plan adoption. That's why our debtors are so high for this quarter. Financial contribution revenue is over the year-to-date budget. Obviously, once again, it's at the moment, it's just phased 1/12, which we're looking at phasing for the next quarter. Subsidies and grants is lower as Azura said, part of that is to do with the Waka Kotahi timing. Also, we have got a budget in there for the pensioner housing subsidy that we had originally budgeted for in the first quarter, but we'll phase that out to reflect where we're anticipating to get that. Fees and charges are in line with year-to-date budget, which is expected. And we've got a little bit more of our other revenue due to some forestry harvesting timing that we've received as well. And then if we look at our expenses, depreciation is slightly lower than year-to-date budget. One of the reasons being is that we're a little bit behind with our capitalisations. So next quarter, that will be more in line with reflecting the actual capital costs that we're incurring. We'll just go to the balance sheet. Sorry, it's freezing. Sorry. Yeah, so if we're looking at our current assets, as mentioned before, receivables are higher, but we're expecting to flush that out the next quarter. In terms of our non-current assets, we're on track with that as well. Payables and deferred revenue is slightly higher as well. That's just a reflection of the accruals that we did for quarter one. And as Azura mentioned before, we've drawn down another extra 5 mil in terms of debt. Any questions?
Just curious, Mr. Chairman, as to you mentioned the capex is just based on a 1/12 or 3/12 of the total, and you're going to phase it next time. Why don't you phase it right from the beginning? Is that just a timing issue and capacity?
Yes, correct. Yes, yep. So within the next couple of weeks, the finance team are meeting with all of the capital managers, and that's where we'll work out the seasonality of any of their spend so we can more reflect what they're expecting to deliver for their work program this year.
It just seems to be setting you up to fail for this first report when it's unnecessary, because we all know that big capex programs don't get underway in July and August anyway. So
correct, yeah.
Yeah, it's just unfortunate, I guess.
Yeah. Grant, did you have a question?
Yes, thanks. Through the chair. I noticed that there's a big variance in reval of capital values and land values. Is that going to have any flow-on impact to what you're thinking in terms of depreciation, etc.?
Yes, absolutely, it does. So we, through our long-term plan, we're definitely taking that into consideration, and we obviously have the results come back now and reflected in the draft annual report as well.
And that was it. Thank you.
Grant?
Yeah, I was just trying to decide whether to ask this question or not, but in terms of financial contributions being above year-to-date budget and driven by mainly planned contributions and roading, but my question is really, did we get an uptake in payment of FinCos from developers as a result of the proposed increases that we set recently?
Adele.
I'm just wondering whether Alison isn't best to talk to this one. As you're aware, we have gone through some very large consents at the beginning of this financial year, and so I'll let Alison speak to some of those.
I think Adele's probably covered off most of that. So timing of financial contributions is very much dependent upon when the developers give effect to their consent. So with the current market, there's a little bit of, I think, jumping in before things got too bad, or there's also the opportunity for people to defer their projects. So we're trying to keep a close eye and engagement with those developers to determine when those projects will kick off, so we can get a better estimation of when we're likely to see financial contributions coming in The value of the financial contributions through the annual plan changes every year. So that doesn't tend to be a big factor in terms of the developments kicking off. It's more what's happening in the wider market.
Because we had one of the particular developer in Omakoroa who was weighing up whether to pay the Fincos now with the prospect that he might not be able to develop them. But if he did, he would have to pay the rates component earlier, sort of thing.
Yeah, I guess every developer's going through that same process at the moment in terms of determining whether to hang fire or whether to proceed. So those financial decisions by individual developers are not something that we can necessarily influence. But obviously, the key thing for us is if we can enable those works to go ahead as much as possible and bring additional housing into the market, then we'll help where we can in terms of giving them surety around their consenting process and what those financial contributions are going to be.
And maybe just as a follow-up, I guess, we had discussed the possibility of, well, maybe this is not the right place to talk about this, but no, I won't go there.
All right. I'll try and forget that and see if I can remember what I was going to say. I was just following up on Sarah's comments regarding the lateness of the annual plan and late sending out the rates invoices has been slower getting money in. There was quite a bit of concern raised about the fact that the penalty date listed on the invoices was earlier than the due date. And so I wonder how that's been managed, resolved. And also the other issue that there were a number of people who had appealed their rating valuations and of course still waiting to hear what the outcomes of those were, and were distressed at the level of rates they were expected to pay, and how's that been managed?
Sure. So first point around the penalty date. So we actually did push that out to give staff time to obviously work through all of the payments and just to ensure that people weren't getting charged a penalty unnecessarily in terms of their rates timing. So I think that we've mitigated that factor. In terms of the revaluations objections, so we receive a file from QV every couple of weeks, and that gives us an update as to whether or not an objection's been successful or not. We have had a couple of ratepayers obviously inquire about where that's at, and in those circumstances we have addressed those ones directly and notified them whether or not the objection was successful and that they will be receiving updated rates assessments once that's been processed through our system. Does that answer your question?
Oh, well, I guess I was concerned about one or two that were, the ones that haven't had their rating valuations updated yet and had huge increases in their rates as a result of those valuations.
Yeah.
I know there were one or two had raised the opportunity, could they just pay what they had paid last year until it was resolved, sort of thing.
Sorry, just through to you, Mr. Chair. In terms of some of those specific ones, we have put through penalty suppressions on them so that they don't get any additional charges. And most of them have been made aware of if we are going through a valuation process.
Okay, that's cool. And if I could just make one other comment in the report on the Treasury policy breach, where it outlines just how much we'd have to pay to comply with the policy. I certainly hope no serious thought has been given to acting that, because I'd be really upset, nearly as much as some of our ratepayers would be if they thought we were paying higher interest rates just to comply with the policy. Might not seem good in terms of meeting the audit requirements, but it's the most practical option.
Councillor Crawford.
So that quantifiable valuation, is it QV that we get, is that the best I was just thinking like, I know some people who are quite glad that actually their property was worth more than what that came in that. So there's the other side too, that some people's properties are worth more but are paying rates lower. I mean, how do you address that, or is that an issue?
Yeah, I think it really is a subjective question there, but obviously there are standards that we have to comply to, and QV have to obviously comply to that. And the Value General does a thorough audit, as you're well aware of the process that we've been through, so it isn't taken lightly. And obviously the revals of some of those that are under the process at the moment are also going through quite a rigorous process as well. So I think at the end of the day, we do everything we can in our hands to make sure that we do the best we can, but you always get people on either side of the coin.
All right, so you have a question, or are you going to?
Just pick up on John's point regarding hedging and you know, with the water reforms being up in the air, and you know, the wisdom of hedging on a falling market, what is the process for us to manage if we decide presumably there's a formal process to follow, if we decide we don't want to follow the policy, you know, we don't just say, oh, we missed it. We must have surely a process to say, at this time, we do not believe this policy is appropriate because of X.
Through the chair, we did acknowledge that in the last quarter report when we first went against policy, and we'll just continue to do the most prudent approach because of the current environment based on our previous discussion. Thank you.
We need to, there is a need for a resolution or anything on those lines from the governance group, us, at some point?
We did acknowledge it in the last report, so I think we're fine, thanks.
All right, so, yes.
Could I just ask, and it's on the side, there's been someone from Audit New Zealand sitting up there and he's gone, but I've never seen that one before from Audit New Zealand, or have I not been looking?
He'll be coming back for his part.
Just through the chair, he's our audit manager, Anton.
All right, so moving to seconder for the financial report to be received. Thank you, Deputy Mayor. I'll second it. All those in favour? Aye. Against? Carried. You do this one.
Yes, and through the chair, and Cedric may also like to talk to this one with me, but it was probably pre his time. But Waka Kotahi have undertaken an audit of our emergency works to look at the spend and how it was managed in our processes during that time. They were very pleased with the overall management, and the report outlines what they looked at. In terms of the audit rating, we were assessed as being effective, which is their highest rating possible, both in terms of the financial processes and the procurement and asset management controls. So very pleasing for council. Thank you.
Pat on the back for the team on that one.
I was about to say the same thing and happy to move, but wanted to congratulate staff on that one. So,
yeah. Thank you. So we have a mover and a seconder to receive that one. Do we need one? Yes. All those in favour? Aye. Gets carried. How much have we got to go? You do lunch first, or? Sorry?
Yeah, that's good.
Yeah. We'll do that lunch first. Oh, right. Yep. So, slight changes here. We've got to deal with a timing issue for our audit man. So, we just need to receive that, the audit and risk program. I don't think there's anything to discuss on that one. Councillor Murray Bench, Councillor Coxett, all those in favour? Aye. It's carried. Right, so we're going to move into confidential now. So that we can deal with the audit man. So that's, we have a new